Good morning, all. It's Saturday morning. Another interesting week in the markets. Never a dull moment. We have a terrific guest today with us, David Nicoski, who I've known for, 15, 20 years. One of the best technicians on the street, and he's going to be sharing his insights and wisdom around his approach to the markets and how he sees things. And really excited that Dave is willing to come on this morning and share his wisdom with us. Before that, just a few comments, and I want to get to Dave as quickly as possible. This past week, I can't say it was really any great surprise. We've spoken before in this room about how in bear markets, and I believe we're in a bear market, you typically see counter trend rallies. We've had John Roque, who's a friend of this room. He's been in the room, and we've cited his study many a time, going back to the 2000, 2002 bear market, where over the course of 2.5 years, NASDAQ fell 80%. However, I believe 47% of the days were up days. And John pointed out that I think there were 15 counter trend rallies of 10% or more, 10 counter trend rallies of 15% or more. So, I wasn't quick enough on my feet to call the market bottom in mid-March. I did not. I tend to be more of an intermediate term investor. I'm just trying to stay with trend. And I'm a big believer in relative performance, which is why I think really one needs to listen very carefully to the way David approaches markets, because it's very consistent with the way I approach markets. But this counter trend rally is very interesting. One of the things I like about getting squeezed is you see what the other side has, and you take some piece of garbage like Robinhood, and they jam it from 10 up to 15 or 16, and then oops, down she goes again. So you use up a lot of the buying power in these counter trend rallies, and you kind of define where the resistance is. And so once it rolls over, you're free to go back and attack as you were before. So I know I'm kind of going on a tangent here, but we had this, I think it was 17% counter trend rally in NASDAQ over, 11 trading days or something like that. It's over. And at the same time, this is occurring against a backdrop of a macro environment, which is really changing day to day, week to week. We'll talk later about a really interesting piece that I read from GavCal Research. I want to save that for a little bit later. But I observe we have rising interest rates. Notice the 10-year yield hitting new, fresh local highs on this move. Despite all the armchair economic geniuses who are blathering on in the public square about the flattening yield curve and how it's going to give a recession, I can't tell you how many reports I've read where people say, oh, rates have to go down, you got to buy bonds, blah, blah, blah. And as I've been saying consistently in this room for months, I disagree. So rates going up, the dollar making a new local high, oil prices coming off but still very high. So we have the triple demerit scenario of higher interest rates, a higher dollar, and higher yields. And all things being equal, which they never are, that's unambiguously negative for risk assets. So I will continue to take the over on interest rates, the over on the dollar, and the over on oil prices, and the under on Cathie Woods, consumer discretionary, financials, technology, and the market generally. So I just think there's again, the oft overused phrase, I keep referring to it. To me, the equity market represents return-free risk. I happened to be earlier this week. I was invited to speak at Georgetown in front of a class of students. It was standing room only, and it caused me or forced me to condense my thoughts in a more succinct fashion. The YouTube video, the video of that is up on our YouTube site, which we just put up last weekend. I think the last show we did was last Saturday with Stan Weinstein, but we now have a YouTube channel up. It's called No Bull, Bull, Market Talk with George Noble. I want to give a big shout out to Carol, Jack, Andrew, and RJ. They would this not would be not would not be possible without their help. They have tirelessly put in a good effort to make that YouTube channel possible, as well as you're aware, we launched a philanthropic endeavor last weekend as well. Carol Strone will be speaking about that a little bit later on. But essentially, I think I mentioned this was coming, but I'll be more explicit now. We provide this for free. There's no personal benefit here. I'd like to continue to be able to make it free for everybody. I think we are providing the best content, period, on Twitter, FinTwit, anywhere. I tweeted out something this morning. It was remarkable. I just kind of toted it up back on the envelope, a list of people that we've had in these rooms the last 3 or 4 months. And this blows away anything you will find anywhere. I was having a conversation yesterday with someone, and they asked me, George, what would it cost to recreate the Fidelity Research Department? I said, I don't know, $100 million. The other person in the conversation said, no, $150 million. Well, we're delivering to you a caliber product, which I actually think is better than the Fidelity Research Department, but leave that aside. And this, you're getting this for free. And I've had some nice comments on Twitter, on the YouTube channel, thanking us for doing this. But what I would like for everyone to do, I'm doing this for no personal gain. I'd like everyone to pay forward. We have selected a charity, World Central Kitchen. Carol will talk about that later. And there's a link on our YouTube page, as well as my Twitter feed and Carol's Twitter feed, to give to World Central Kitchen. They are really doing God's work. It's just unbelievable. Carol will share some stories with you later. And so rather than charging for this site, we're harnessing all the good work that people like Dave Nikoski, Stan Weinstein, Michael Belka, Michael Green, just go down the list, John Roque. And I would hope that everyone would reach down and give generously to World Central Kitchen, give back. And so I can't implore you enough. The other thing I would just say in passing in that regard, I'd ask everyone to go to our YouTube channel and please subscribe to the channel. That will help us a lot. We need to get up to, I think, at least 1,000 subscribers. I think we're up to 280 now or something like that. So, I can't urge you strongly enough to give generously to World Central Kitchen. And please, please, please follow us on YouTube. All right, enough of that. Now let's go to the issue before the House, the matter of the day. We're very fortunate to have David Nicoski here. I've known David, again, since the early OOs, I believe. Mid OOs. I can't remember exactly what year it was. Used to be, it was a client when I was running my hedge fund. David is a chief investment strategist for Vermilion Research out of Minneapolis. He's well known and well regarded in professional circles. Dave is a big proponent of relative performance. It can tell you a lot about what's going on, where the market's going to go, et cetera, et cetera. And I find his observations, his approach to be really, really worthwhile. Because I don't know about you guys, but it's easy for me to get caught in my personal thinking about what I think is happening or what I think should be happening. But nothing focuses the mind better than a graphic depiction of what actually is happening. David provides that perspective. So, as is usual, David, floor is going to be yours. Let it rip. Talk as long as you want. I'll follow up with some questions. And then we're going to have Carol speak about Central World Kitchen for a little bit. And then we're going to open up the floor to questions from the audience. So, without further ado, David, the floor is yours. Welcome, David. Good to see you.
Thanks for the intro, George. I appreciate the opportunity to speak to the room. I'm just going to go real quick about a little background information. I started my career marking up charts in the 70s by hand because we didn't have PCs back then. My father, who was a well-known technician, Edward Nicoski, I learned under him. He was formerly worked with Steve Luthold, which is a name that, if you've been around for a while, you know who he is. So we started Vermilion back in 2005. And what we look at is we look at the market from a top down and a bottoms up basis in terms of sector performance, industry group. We have our own proprietary product that measures relative strength. We were one of the early pioneers back in the 70s to do that. And I think it's, it does add, as George said, a completely different perspective to what is actually going on in the world. And it's literally building a giant puzzle to determine where money flows are by tape action. I think that when we look at this market right now, what we're seeing from our side of the table is absolutely inflation's taking place. I hear a lot of people trying to call oil top and commodities tops. That's typical at a secular turning point. We've gotten accustomed to 10 years where oil has been down, and now we're starting to move higher. Uh, some of the arguments that I hear on that, when we look at various sectors, you have technology roughly over 30% of the market, and it was, much higher at the actual peak when all stocks were rising versus the, top 50 tech stocks. Just to give you a little perspective, right now energy is 3.9% of the market. In 2006, it was 9.8, 14.3 on 3/9 of '09. So you could considerably have a double and marginally get to what the median is over the last 40 years. So keep that into perspective when we're looking at this market. I agree with George from the perspective that I think tech is done. I think the financials are showing a wipeout. The Fed's going to start tapering the balance sheet. And right now, when you look at charts, and I'm a chartist, so I kind of like to look at a chart and go back and find a story on issues that are breaking out or an industry, and do some research on that, to provide that fundamental backing for why the chart's doing that. And when we look at ETFs such as MBB, which is mortgage-backed securities, we're not far from the '08, '09 lows. You look at LQD corporate bonds, in a straight dive down. Um, HYG, JNK are showing much the similar patterns. You haven't taken out the lows yet, but it's more than likely that you will. I think we are entering into a recession. I think that commodities will continue to outperform. I think hard assets are the things you want to own here. Looking around the world, there's a lot of attention given to the US dollar index. Realize the index has not changed in 50 years since its inception. So you have what I would call is we're all focusing on an index, and much like the S&P, it has survivorship bias. You have less than 50% of the stocks in the S&P 500 today than you had in 2000. So it truly is survivorship bias. The same can be said about the U.S. dollar index. The U.S. is the strongest house in the neighborhood of all the constituents that are residing in the U.S. dollar index. I think there's not enough attention paid to what's happening outside of it, and I'll give you an example. When you look at Brazil, you're breaking an 11-year uptrend in the U.S. dollar versus the Brazilian real. Again, it's a commodity country. What I'm noticing from our work is that you have significant amount of emerging countries that are commodity rich, be it Indonesia, Brazil, South Africa, Peru, Chile, Australia, that and Canada that look absolutely fantastic. It's remarkable that despite the sanctions on Russia, we actually have the ruble is actually taking out the pre-war levels. You've had a considerable gain in the ruble. There is demand for commodities around the world, and that's what's driving the inflation aspect to the market. I think unfortunately, I think the Fed has got themselves into a bind, and they're going to have a difficult time selling mortgage-backed securities when they're at their lows. It's telling you no one wants to buy them, and they're probably going to drive prices even lower. And that would be my greatest concern, is that we're going to have a correction in the real estate market. It's going to be considerable, but we're going to see it on the back of higher rates. When we again looking at this market, I look at a chart of Goldman Sachs or Citigroup or the KRE index. Those are not healthy. Usually when you see that in the brokers, they're usually the first to peak out, and I think there's evidence there that there's a canary in the coal mine. When you look at the London's Metal Exchange and their activities of halting, nickel trading. Um, they're begging the EU for capital to continue to hemorrhage even more. And I think that's of great concern to me that when you look at oil, it's in backwardation. Everyone got it wrong, and they were getting it wrong prior to the Ukraine Russia crisis. I think there's much more to go to the upside. I think that what we see from, and not to get into politics, but from what energy company CEOs feel about the administration, they're not too eager to turn on the spigot. I think that when you look at drilling from 2019 to present, realize 2019 was not a good year for energy companies. Drilling in the US was down 43% right now, as of about a month ago, from January of 19 levels. So well before COVID. And again, the sector was already going down. Worldwide, you had um, drilling down just about 30%. Um, so, that causes great concern to me as a technician, and looking forward that, what we didn't drill last year or the year before is what's going to haunt us in the next 2 years. In January 21st of 2021, we published a report saying that we think we're entering a secular bull market. Our group did the same thing in late 2002, prior to the big run up in energy, prior to the move above $40 a barrel. I see all the same circumstances happening. You had 389 tankers that were scrapped during the low points of energy in the last 2 years. It takes 9 to 15 months to build a tanker. You have dirty tanker rates breaking out to new highs. When you look at Europe, and again going back to that US dollar index scenario, when you look at the currencies that contrive the US dollar index, it's the euro, it's the yen, it's the British pound are the main weighting. You can see what's happening to the yen. Japan is a country that doesn't have a lot of commodities. They import most of their oil and natural gas, much like Europe. UK natural gas is up 20-fold. Europe natural gas is up tenfold from the bottom. We're up just slightly over sixfold. They cannot compete. They cannot build anything. They're shutting down zinc smelters. They're shutting down aluminum smelters. They're shutting down steel smelters. They are doing everything they can to attempt to at least diminish energy consumption, especially when they can't compete on a global basis. I think that, when you look at what Europe is going to need due to these sanctions, I think you're going to see bulk rates actually move higher. They're going to have to import a significant amount of coal. You're going to see that ag stocks are going to continue to move much higher. Um, and that's based on fertilizer. I think one of the best countries that you can look at in terms of commodities and agriculture is actually Brazil. So it goes in line with what I'm seeing in terms of the Brazilian real inflection versus U.S. dollar. Um, there's a big move to electric vehicles. When you look at lithium, it's up almost 2,000% since 2014. Just in the last 12 months, up 465%. Nickel's up 98%. Cobalt's up 83%. Uh, it's going to take a massive amount of capital to search for this. Most of you may have seen the tweet by Elon Musk suggesting that he was going to start a lithium company, and he tweeted that out yesterday. There's a severe shortage of the very things that climatologists want us to do, and it's actually going to consume a lot more energy to find it. I think that's uh, the double-edged sword. You might get what you want, but it's going to cost you a heck of a lot more than you're willing, and the results or impacts of looking for it is going to take actually more energy and a lot more crude oil and natural gas to find it. So uh, I'm like I said, I think that staples and utilities are attractive. My concern about that is when you do enter a bear market, as Hannibal Lecter often says, you can only live off of relatives for so long, and that's my concern. There is that they're starting to show patterns that are depictive of runaway parabolic upside move chart. So the panic is growing in the marketplace. in terms of finding safe havens. And again, I think the energy and commodities are going to do better. They will be impacted if we have a meltdown, but I think that's the place that's going to hold up much better going forward. With that, George, you want to do
Yeah.
questions?
So that's thanks for that, David. That's a really concise tour de force, unambiguous. It should be very clear to anyone listening to you what's on your mind. So let's back up for a second. David, what year did you enter the business? David, what year did you start in the business, please?
I actually was marking up charts back in 1980 and doing it by hand. And I was I was doing it for my father who worked at Piper Jaffray. I did work with him for many years, and in 2005 left and started Vermilion.
Got it. So what I wanted to ask you is from your perspective, because you've seen some cycles, what are the most important changes that you observe, and how have they impacted the way you approach the markets? I mean, still the name of the game is to buy low and sell high, or if you're a relative strength guy, you'd say buy high and sell higher. But when we talk about the increased volatility, the incredible speed of the moves, the fact that we really not had a proper bear market, we get these sharp declines and it rallies right back up again. How have you adopted over the years in terms of the way you approach things, or has it really just been sort of minor tweaking around the edges, and your basic MO is pretty much the same?
Yeah, we don't focus on as much on, trade entry in terms of, day to day. So we're not short-term market timers. We're looking for, longer term inflections. Realize that a chart breaking a 2-year uptrend or a 2 week, downtrend, for instance, is not as important as something that's breaking a 10 or 12-year downtrend. And I think we were early on the fertilizer call on uranium. We were marking it up, 18 months ago, and they were secular changes. They weren't something that was just developed only because of Ukraine and Russia. You could clearly see that there was inflections in the long term charts of those two industries well before there was any issue. Regarding a war outbreak. So, looking at the market now, it's when you get into much more volatile times, you're going to want to own things when they pull back to the uptrend. If they are indeed in secular bull markets, that's the safety net. Look where the 200-day average is. When I see charts 20 to 25% above the 200-day, I have no problems telling someone to take some profits. And if they like the name, like the industry, come back at it when it's closer to the 200-day. We've done a
Yeah.
lot of.
So let's just use that as a jumping off point. So broadly speaking, I have a very similar worldview to yours.
Okay.
Having said that, the energy stocks have come a hell of a long way. Um, but as you rightly point out, it's not just Russia. Russia was kind of like the icing on the cake. These stocks were performing extremely well for quite a long while. I note your statistics, by the way, on the percentage of S&P accounted for by energy were really insightful. What I wanted to add to that is, whereas energy might be 3.9% of the S&P in terms of market cap, if I'm not mistaken, it's about 6.5 or 7% of earnings right now.
Okay.
And that's going to go. Sorry to bring the fundamentals into it, but I was having this discussion with somebody the other day because, as we know, the energy stocks sell at a big discount to the market in terms of valuation. And so when you take that into account, again, they could probably account for almost as much as 7% of S&P profits. And prospectively, as markets live in the future, with energy earnings growth set to wildly outpace uh, market earnings growth. If market earnings are flat or down a little bit, maybe even up a little bit, which is they're not going to move that much. And you stop and think where energy prices, if we just have energy prices sustain at these levels for a year, what energy earnings will look like in 2023. I mean, you could conceivably have energy being, I don't know, 10% or more of S&P profits, but yet it's only 3.9% of S&P market cap. So again, the point is not one of accuracy, precision, it's one of accuracy. So coming back, David, so right here, right now, okay, great. So you can take a victory lap. You nailed the energy trade and the agriculture and the fertilizer, all that kind of stuff. But these guys don't. Everyone else in the room doesn't know you from nothing. Okay, so say you're going to a client for the first time. You're not a genius because you got it right. You're also not a dope because you got something wrong. Right here, right now, and you're only as good as. And again, It's not like we're not looking for a tip here, like what to buy, what to sell. You've made your views broadly concerned clear. But from a sort of timing or tactical standpoint, if you went to a new client and you don't want to blow them up the first week, and they say, "Hey, I got 100 million bucks to invest," what would you be telling them to do here? Wait for a better entry point because, i.e., energy is overbought. It's too much
Yeah.
above 200 MA, and you can't short Kathy Woods and all her related stocks because they're down too much. Like, what would you be doing right here, right now, or do you think discretion is a part of valor and you would only wait in
Yeah.
slowly? What would you be doing?
Great question, George. What I would say, continue to buying energy stocks. When you look at it, most of the stocks. I mean, you take even a name that's run up significantly, Oxy Petroleum. It's not even near its highs back in 19 when oil was trading 60, less than $65. We have oil considerably higher. I do think that there's a possibility that oil pulls back, but I think that they have the wind at their back. 100 companies declared bankruptcy in 2020. You had 30 companies in the energy sector declare bankruptcy last year. The same thing that occurred in 1998 is happening now. Back in 1998, you had oil that went below $11 a barrel. Every magazine cover came out and indicated that uh, oil would be $10 for the next decade. Um, most of the companies in the energy patch, if you were a CEO, you didn't want to expand. You just wanted to pump and maintain the wells that you had. You're seeing that same thing. There is a shortage of parts out there for the energy companies. They can't get casement to put down in the wells. So you have, I think, all of the ingredients that you had back in 1998. On a quiet night in 2000, you could hear a sucking sound from the east, and that was China. I think your sucking sound right now is coming from India. And when you look at India's market relative to ours, it is significantly doing much better than what we are doing. Um, so I think they're going to continue their uh, imports are going to continue rising there. I think you're going to see more onshoring here in the U.S. because of the supply chain issues that we have. But you're going to take a lot of energy to also transport the goods to Europe that they are no longer getting from Russia.
So, so,
Um,
so Dave, again, and that's a great answer, and again, the spirit of the room, in that we're always trying to help people, teach them how to fish. You give them a livelihood, as the saying goes, as opposed to giving a man a fish, you give him a meal. So this room is never. It's the first time, man. You were in one of my rooms like a month or two ago, and I don't know how much you've been in these rooms, but we're not into giving picks. It's more just how to think about investing. By the way, I have to chuckle. You're in the upper right hand corner. If you look two over, my co-host O'Hare, he's a really good guy. He's an experienced portfolio manager. He's got that great cover for his avatar. It's the Business Week 2019, I believe, is Inflation Dead, which leads, as Yogi Berra once said, you can observe a lot by watching. Which leads to the question: what you're talking about. I just want to make sure everyone in the room understands this because I believe I got it. I want to make sure we're all clear on this. Your outlook is kind of like a secular structural call, if I'm not mistaken. It's kind of in the same way. If you got the tech and the FANG trade right for a good number of years, going back from 2015 or whatever it was, you could have milked that for quite a while. Your call is really a longer term structural call. Is that right? This is not just a 3 month wonder. Do I understand you correctly?
that is absolutely correct.
So, there were some guys who just, they bought FANG stocks and they mailed it in. I mean, without being too cavalier about it, if you just, and I see Marcellus. By the way, you have to know, Dave, you're in Minnesota. How far are you from the Canadian border? How far are you from the Canadian border, Dave?
Well, no, I'm far enough away from the Canadian border,
All right.
several hundred miles.
I just want to let you know we have these groupies in here, and I'm actually, even though I'm in New York, I'm an honorary member. We have them. They're affectionately known as the Canadian Oil Mafia. Okay, and you may look down the third row. You see Marcellus keeps putting these crazy things up there. There's a whole bunch of these guys. they've been all over the Canadian oil trade, and they've absolutely killed it for all the right reasons. And this is music to their ears. So I'm sure you'll probably get some questions from them later. But no, I agree. This is a structural trade. This is a structural trade. Could we now go to the other end of the playing field? So we're down at one, the 10-yard line of the energy. Let's go to the other extreme. I've been calling out the long energy, and I just picked XOP as a placeholder for that long energy short Kathy Woods. And this market's sort of taken on biblical proportions. The last shall be first, and the first shall be last. To me, I don't want to lead the witness, but to me, Kathy Woods and all the assorted garbage, you know what I'm talking about. It's the inverse, and to me, those look like just serial structural underperformers. And so I'm not taking a victory lap here, but anyone's been following me. I mean, I started mentioning this trade last summer. I think it's worked. It's 150%, if not more, being long XOP, short ARKK. Now, you don't have to pick those particular instruments. And by the way, everyone in this room, do your own work, do your own research. David's recommendations, my recommendations, they're not recommendations. This is just our own personal opinions. So we're not responsible for, if you go out and you buy energy stocks this week and they have a big correction, don't blame me, don't blame David. We're all big boys and girls here. But David, what would you say to people who are they really killed it with long duration assets for a long period of time, and now with rising rate, I mean, everything's wrong. The charts are terrible. They're breaking down. The macro factors are wrong. This tech is still widely overowned. Blah 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 blah. So, I know I'm asking you to broad brush it, but generically, what would you say about that part of the market, David?
I think it's done. Everyone wants to run into names like Amazon, and when you look at the relative strength of it, it's done nothing but go down for a year. Amazon's a delivery company. 70% of what they do is delivery by truck. If they're charging Amazon Prime, and having to deliver with today's diesel prices, um, I just don't. I can't fathom what the numbers are going to look like. The last numbers were brought out by Rivian. I don't think that Rivian is going to be able to get any lithium or any supplies to build it. And you're seeing that even with the likes of Tesla, who switched on the lower end cars to an iron phosphate battery in China because there is no product for them to get. So I would say, pick your spots. There will be a bottom someday, but if it doesn't have earnings and if it's not consistent earnings, the areas that people tend to go to in technology during troubled times is the IT service companies, because they have a continuous revenue. It's not going to fluctuate with cyclicality as much as a semi stock, Nvidia. You know, if we have inflation, and you're 10% of, and I'm not a Bitcoin nut. And you and I talked about this before I did this call, George, on gold. I'm not a gold nut until I need to be. And it's about trends. It's about inflections. But when you look at something like Nvidia, for example, and you don't have much mining left to do in Bitcoin, is that stock going to hold up if we get down to 3% of Bitcoin to be mined? That window's closing. It's much like Gilead coming out with a cure for hepatitis. Well, what's the end game? Once you cure it, you aren't going to sell anymore.
Right. So, David, let's move a couple more questions, and then I want to go to the audience. We'll have Carol Strome come in for a second, but a couple more questions, if I may. I look at oil and I look at rates or bond prices. I said earlier at the outset, and I've been saying this consistently, I'll take the over on oil, and then more importantly, oil equity, energy equities, whatever people are saying. I'll take the over on yields. So people say how high is oil gonna go? I don't know. Nobody knows. But a fellow Minnesotan, Larry Getalo, who you may know, who's a friend of this room, he was in the press this past week, I think, in front of a UBS group. He thought oil was going to 200 or 300, and rather than get caught up in what the price is going to be, nobody really knows. Point is, it's going up, and it's going up a lot more than people anticipate. That's my own opinion. I have narrative to go with that. And ditto on rates, I can make a case for I think rates are going to go up a lot more than people imagine. There's just sort of complacent view around the place. Well, the yield curve is flattening, and housing prices are going to start to go up at a slower pace because mortgage rates are going to go up and blah blah blah, and bonds are oversold. You should be buying bonds, buy the dip, buy the dip. And I'm like, no. Everything I look at fundamentally, I can give you reasons why I think yields are going to go up a lot more. But then just fundamentally, again, look at the charts. Trade what you see, not what you think. When you look at the 10-year, I'm going to put you on the spot a little bit. When you look at the 10-year, or you look at crude, like, again, I'm not going to hold you to a single point estimate.
Yeah.
But
No, that's fine.
just order of magnitude, where could you see the 10-year going to? Where could you see WTI going to, David?
I think on energy, we're going to see it go higher than anyone can think possible. I mean, you're emptying the SPR. You have a shortage of diesel around the country. Austin Airport, contacted the White House last week and said they were almost out of, jet fuel. You have that at a number of airports. When I'm looking at the 10-year, you start to break through that 2.8 level. That's a secular downtrend. And I want to caution because, you know, everyone's tried to call that secular reversal in the 10-year, and it depends on how wide of a marker you want to use. But 2.8 is our level in the sand at which, if you proceed higher through that, for any amount of time, and when I say amount of time, I mean I need it weeks, maybe a couple of months. I think that it's a high likelihood that that will do a secular reversal. When I'm looking around, and seeing what the Fed has done and engineered this QE, and we that is not something that's been done before. It's new. It's a manufacturing of accounting. Um, an example, Wells Fargo. One of the things I learned from my father was, in the '70s when inflation took off, you changed your accounting. You went in from first in, first out to last in, first out. Well, WD-40 reported the other day, gapped up strong. It lost most of its gains, or some of its gains during the day. They changed their accounting, and that is what I would expect to see. Is you're going to see companies that are seeing high input costs are going to change the way they do their accounting and how they report it to the street. And you're going to see funds from operations drop dramatically in this cycle. And I,
David,
and I think that's what we're starting to see as companies report.
the, the,
Um,
the- David, you're spot on. There's another a good friend of this room. We're going to have him back in the not too distant future. But Dr. Jim Walker, one of the best economists, I should say, I know. He had a really differentiated way of describing the world, and he was talking about the ex post versus the ex ante world. In other words, pre COVID, pre all this massive dislocation, we had well defined rules of engagements and cycles and mean reversion, all this sort of stuff. But we're now in a much different world. We're in the ex ante world, and the rules of engagement are much different. And it's funny. He spoke about when he started professionally in the '70s. He was working as an auditor, and it's funny listen to you talk. He spoke of exactly what you touched on, FIFO versus LIFO, that when you start having inventory profits or losses, they become very material. And the bigger point he was making was, given how much prices have shifted, how much prices have gone up, so many companies now, they don't really know if they're making or losing money because they don't really know what their input costs are, or what they should budget for their input costs. They're not sure they're selling prices, even if they're up, are they sustainable? If anyone wants to look at my Twitter feed, yesterday driving back from Ned Johnson's memorial service in Boston, where there's a nice photo actually of my feed standing next to Peter Lynch and Guy Sorrendulo. I stopped at a deli outside New Haven, Connecticut, and you should look at the feed. I thought it was pretty funny, but I have a crazy sense of humor. And there was a sign out front. It said 10% surcharge on all food items. And then I go inside, and there's a sign on the counter which says they've reduced the surcharge from 15 to 10. So I made this wise ass comment. Oh, well, that means we're actually having deli deflation because the last few months they reduced the surcharge from 15 to 10. So we've got deflation in the deli. So it wasn't transitory after all. But it's all a long way of a smart ass way of trying to give you a comeback. I totally agree with you on this inflation thing, and that dictates a much different type of company that you want to own. I mean, heretofore, owning a virtual company which had no assets, that was the way to roll. return on invested capital was extremely high. But if prices are up and to the right, and you're a price taker, and you have to have the goods no matter what the price is, you actually want to own companies that are asset heavy. And so that plays in beautifully to fundamentally to your sort of technical observation as to what's going on. So
Yeah.
I couldn't agree with you more, David. All right, let's just stop right here for a second. I want to reset the room. We've got Dave Nikoski from Vermilion Research. I'm going to put in a plug for Dave. He didn't ask me to do this, but they're widely followed by a lot of some of the most high end institutional clients you could imagine. But they've got quite a number of clients, some bigger, some smaller. I'm sure they'll be happy to take on new clients if anyone's interested. You can reach him either through Twitter, or his email address is Dave at Vermilion Cap. That's VREMRIR Vermilion, VERMILION cap.com. Dave at vermilioncap.com. And he'll probably hit me for saying this, but I'm sure if you reach out to Dave and tell him you heard him on this space, he'll probably give you a deal, but whatever. At any rate, so we're here, we're talking markets and relative performance with Dave Nicosi of Vermilion Research. We're going to go to questions in a minute. But before we do that, if Carol Strone is in the room, I would like for Carol to come up and speak a little bit about what we're doing with World Central Kitchens. And Carol, here she comes. Carol is a professional. She's got a lot of experience in the world of philanthropy and investment management, and so she's very much in the weeds on this stuff. And she's done a lot of great work talking to World Central Kitchen and also other sources, trying to get a handle of what's going on in Ukraine. And I thought it'd be really helpful, and Carol's willing to do it. She's one of the ones that's making this all possible, to share what she's learned about what's going on in Ukraine and how we can help. So, Carol, always good to hear you, hear from you, see you. So, Carol, the floor is
Hey,
yours.
George, how are you?
Doing
Good.
well.
Good.
Go
Well,
for it.
first of all, I want to thank you for these amazing Twitter spaces, because I'm one of the ordinary investors in the room. So I'm here to learn, and your guests like David are just an extraordinary resource for me and an important part of my own personal educational journey. So thank you so much for everything you're doing. Okay, so on to World Central Kitchen. And you can't really talk about World Central Kitchen without first saying a few words about its founder, Chef Jose Andres. His story is the classic immigrant success story. As a young man, he moved from Spain to the United States with $50 in his pocket. 20 years later, he's an award-winning celebrity chef and restaurateur. And if that wasn't enough, then in 2010, he founded World Central Kitchen, which provides food assistance to victims of natural disasters around the globe. First, he was in Haiti after the earthquake, then in the Dominican Republic, Nicaragua, Zambia, Peru, Cuba, Uganda, Cambodia, the US, Puerto Rico. So wherever there's a major flood, hurricane, earthquake, he and his team try to get there to partner with local chefs, farmers, other food workers to essentially feed millions of people in need in times of horrific food scarcity. So now they're in Ukraine in the middle of a war, something they've never done before, which brings me to the heart of the story that I really want to share with you all today. 3 weeks ago, I read a piece in the Washington Post in which the CEO of World Central Kitchen was, are you, sorry, I'm hearing some
Sorry, Carol, I don't know. Thomas, could you please hold on just 1 second?
You there?
Yeah, we're here. We're good. Okay. All right, Carol, I apologize. There's some background noise. Okay, go ahead. Continue.
So anyway, 3 weeks ago, there was a piece in the Washington Post, and they were interviewing Nate Mook. He's the CEO of World Central Kitchen, and at the time, he was on the ground in Ukraine. He and Chef Jose Andres, they'd been there since the day 2 of the war. And the interview, which caught my eye, was titled, "Where is Everyone?" And Nate shared in that interview how he was in Odessa, and he'd expected to see a lot of outside international support. But instead, what he found, and what they've found pretty much throughout a lot of Ukraine, is that these cities and towns are largely fending for themselves. There are a lot of local volunteers, a lot of local organizations, but not the usual number of organizations that you would expect to see and that they have seen in natural disaster situations. So why was that? I reached out to Nate, emailed him in Ukraine, never thought I'd hear back from him, but he did write me back in the middle of the war and, said honestly he could speculate, but he really didn't know and he wished he knew. So I decided to go ahead and get some answers, started calling around to a number of organizations that I've worked with over the years. And it turns out, since all of us are now becoming armchair experts on war, that it's a very select group of organizations willing and able to operate in an active war zone. Now, why is that? Well, primarily, we can all understand it's safety concerns. Some are worried about exposure to liability, public backlash if, God forbid, a member of their team gets wounded or killed. And then, consider the fact that Apple Maps, which Chef Jose Andres and the World Central Kitchen team have been using to navigate around Ukraine, kept sending them into Russian-controlled territory. So, the danger, of course, is very real, and these humanitarian workers go in with no weapons. They do have security teams, but it's dangerous what they're doing. And it's also the logistics. In wartime, charities can't send aid through the normal channels with ports blocked and roads being treacherous with bombings and limits on fuel and transportation and volunteers. And plus, a number of organizations who I talked to said, honestly, during COVID, we scaled down dramatically and we haven't scaled back up yet. One organization had a staff of 200 and they scaled back down to 40 and they're still in the process of scaling back up. And they're one of the organizations that used to partner on the ground with World Central Kitchen. And then you have the fact that some organizations take the position that their mission is limited to natural disasters and they don't consider war to be a natural disaster. It just doesn't fit their mission, so they're not going to go in. And then you have the very sad fact that a lot of charities are already stretched well beyond their limit. They're fighting hunger in Afghanistan, Yemen, Africa, Syria. And, in Georgia's space last week, Stan Weinstein talked about the frequency and the speed and the intensity with which things are happening in markets. Well, the same thing is happening with disasters around the world right now. And we are probably going to see some more Arab Springs, and food scarcity is going to become a bigger and bigger issue. So in the end, it comes down to a very personal choice for someone like Chef Jose and Nate Mook and all the World Central Kitchen team to decide whether they're going to go into a war zone. And for them, it wasn't even a question. They were going to go into Ukraine. And honestly, I'd like to think that I'd be brave enough to make that choice, but would I? And how many of us on this space today would be? I don't know, something to think about. And so all this is to say that World Central Kitchen is among the many remarkable profiles and courage in Ukraine at the moment. You've got President Zelensky, all the Ukrainian people, and these amazing humanitarian workers who are showing us really the best version of ourselves. So apart from that, George and I, when we were talking about what charity we wanted to suggest that people could get back to, we also wanted to choose a charity that would resonate with as many listeners as possible. We've got people literally in the Middle East, the UK, India calling in on these calls. And I recognize the fact, and so does George, that charity is personal. So how do we make it personal for all of you? Well, in cultures around the world, food forms the heart of a community. And we're a community of listeners, a growing community. And World Central Kitchen seemed like the logical place to start. So that's what I have to share with you today.
Thank you so much for that, Carol. And Carol, if you wouldn't mind staying on stage, please, because I'm sure that people probably have some questions or thoughts. I mean, you and I have spoken a lot, gotten to know each other in the last couple of weeks, and I just have to say, for those of you, I'll repeat what I said earlier, that there's a group of 5 of us. Carol's one of them. We didn't know each other 2 weeks ago. Carol and I both happen to be in the New York area, but I want to call out Andrew, who's in Virginia, and RJ, who is in, I believe, Tulsa, Oklahoma, and then Jack, who's up in Hanover, New Hampshire. We didn't know each other a week or two ago, but we've come together through this remarkable medium of Twitter Spaces. And Carol and the others are all giving up their time, as am I, for no personal gain. We're just trying to get back, and we ask all of you to pay forward. And so there's a link, Carol and her Twitter feed and my Twitter feed. It's also on our YouTube channel. We've made it easy for you. Just put your credit card in there, and the money goes straight to World Central Kitchen. There's no GoFundMe page, no middleman, none of that. And I want to. I'm not going to mention or embarrass people by name. Some of you have been incredibly generous, and you're on this stage now, and you know who you are. I have, and I can't thank you enough. And I have to tell you, there was one donation, and this person's on stage now. He knows I'm talking to him, and I put this in my Twitter feed the other day. He allowed me to. I redacted his name, but I put it in the Twitter feed, and it was true. I mean, I literally broke down and cried. He was so generous, and I ask all of you to give similarly, because what we're dealing with here, this is a first world problem. How do we protect our wealth or increase our wealth? This is pretty small stuff compared to what some of these other folks are going on. So are dealing with. So I can't ask you enough to consider, especially. And look, everyone gives to their means. I mean, if you're a young person and you have a negative net worth, okay, fine, I get it. But if you've got a few $100,000 to your name, a few $1,000,000 to your name, you know, Carol's a great wallet surgeon. She's made it easy for you with this link to World Central Kitchen. Just click on it and put your credit card in, and we'll make it easy for you. And again, consider the value that you're getting from these rooms. I mean, again, I don't think there's another source anywhere on the internet, period, that comes remotely close, because it's open architecture. I mean, we got Dave Nikoski, not to blow smoke up his backside, or beneath him, Michael Kantrowitz. Okay, these are people that ordinary folks don't have access to. Tens of thousands of dollars, hundreds of thousands of dollars to get their work, and you're getting it for free here. I don't know, I'm starting to sound like one of these guys who's trying to hawk solicitations on national public radio or public broadcasting, but I can't say it strongly enough. And I think we've raised, I don't know, like $15,000 now, something like that. We have a goal of 200. I understand Rome's not built in a day, but one of the things Carol and I have been talking about a lot is how do we harness the power of Twitter and social media as a force for good. And this is our attempt at it. And Carol, maybe if you're still there, Carol, maybe you could just talk a little bit about generally the problem. It's kind of interesting that I don't want to say that first mover advantage, because we have no advantage. We're trying to figure it out, but just generally the challenge that traditional philanthropy has in trying to figure out how to harness social media, because I know you had some very interesting conversations around that topic.
Yeah, I'm happy to comment on that. One thing I wanted to say as well is why did we choose 200,000 as our goal? So I asked World Central Kitchen what the most amount they had ever raised from one online fundraiser was, and they said 180,000. So George and I, shooting for the stars, thought, okay, we can beat that. So I'm hoping we can. We've got time. So that's one thing. And then second thing is, George talks about a lot about the fact that technology has canceled boomers. This is only my second time on Twitter. And when I've started to call around to a lot of the CEOs at these organizations who are boomers or older, and they do have young people on their teams, tech savvy people, but they were sharing stories about, well, funny you should call, because last night I was at a fundraiser dinner in Palm Beach, and one of the things we were talking about is how do you crowdsource funding online? They had none of the people I've spoken to have even heard of Twitter Spaces. So start there. We're at the very beginning of open architecture, as George says, trying to figure this out to see if the power of numbers can make a real difference in a new technology. So does that help, George, answer that question?
Yeah, thanks for that, Carol. Really appreciate it. Okay, so Carol, stay on stage. Aside from the investment questions, anyone has a philanthropy question or World Central Kitchen, feel free to chime in. Okay, so let's start off. We're going to go with Marcellus, and then Storm City. Marcellus, good to see you. What's up, my friend?
Hey, George. Thanks for taking the time to host today. And David, Thanks for giving us your time and your expertise. Do appreciate it, and as George said, I'm sure you've made a lot of new friends here in this room from guys that have sort of taken that Canadian oil mafia moniker on proudly. I'm curious, and this is to George and David. The more things kind of move along here, the more it feels stagflationary to me. As we move down this path, and I'm just kind of curious, what your, both of your takes are on that potential as we continue forward in this cycle.
David, would you like to go first on that, David? I don't know where. Maybe he'll jump back in. So let me take that, Marcellus, and Dave Nikoski. Please unmute yourself. You're okay,
Yep,
Dave. Dave, why don't you want to have a shot on that first? Go ahead.
Yeah. Well, just aside from George's deli comment, I had my son in the car yesterday, and we stopped at a McDonald's, and we both got a value meal. I don't know how they called it, a value. It was $20 for two meals, and
what? Wait. $20 for two freaking value meals? Are you serious, Dave?
1909, and there was no side items, and those were just the. I got a Big Mac, a fry, and a Coke.
Wait. I have my kids are grown now, but is that still supposed to come with a toy?
I wish it did, because it would have been worth it.
George, I can attest to that. He's dead on accurate. That is real what he's talking about.
And part of it is the growing inflation. Growing inflation in wages. I mean, when you can't find employees, you're the guy behind the counter, and no discredit to anyone based on age or age discrimination on this call, but it was a 15-year-old kid, and he just stood there behind the register. He didn't help anyone out. I was the only one at the counter. He stayed there for 10 minutes while they're getting my order, because they do all the drive-through first, and I'm sitting there going, why isn't he helping out? There's no one in the store. So there's a kind of a bent to how I think in terms of efficiency in the world. And I worked at fast food when I was 15. So, but I worked hard. I mean, I tried to help everyone out. I'm the guy that wants to make things work, and it's just amazing because we're seeing inflation through wages, and I've never seen a fast food restaurant go, hey, we're going to pay you $14 an hour, and inflation subsides, and what do? Change it to $7 an hour? No, it's never happened. So the wage inflation is here to stay unless they lay you off. I think we're going to see a tremendous amount of layoffs when it comes to the housing industry. I think the auto industry is going to see a significant, but it's going to make the internal combustion engine much more effective in terms of delivering it versus the cost increases you're seeing in aluminum. So I would agree with you. I think we are seeing the 70s just without the embargo at this time. When you see headlines that Saudi Arabia is not going to take calls from, and the United Arab Emirates are not going to take calls from the president, I think there's a view there that something's changing, and they have much more control over the world. The U.S., I would say, fortunately, we do have enough oil here. The problem is we're going to be sending it over to Europe now. So we do need to increase that, and we need to increase it significantly to make that shortfall, whole.
Yeah, I think that's very well said, David. I would add a few points. One, the whole issue of deglobalization. I think this is a new factor that we haven't quite gotten our arms around. But the shortening, I think we're done extending supply chains. The reshoring of some production means or shortening of supply chains. That's going to bring with it higher inflation. I hesitate to use the word stagflation because that conjures up a lot of visions or meanings that maybe mean different things to different people. As I recall, the 70s, yeah, we had higher inflation, we had slow growth, we had high unemployment. We have very low unemployment right now. In fact, we're at full employment. In fact, I can make the argument that we've over-egged the system and we need to have more slack in the labor market. So, It's similar to the 70s, but it's different. I mentioned deglobalization. I mentioned the fact that we've overcooked the system and we're at full employment. Um, we've also had, and this buds for you, Canadian oil mafia and Marcellus. We've had massive underinvestment in many extractive industries, most notably energy. And as we know, that's not going to fix overnight, especially when we've got ESG involved, which is another factor just making the whole situation worse. As the saying goes, the solution for high prices is high prices. But the ESG crowd is hell bent on making sure the market mechanism doesn't work to solve that problem. I think we're going to need a crisis actually to change political opinion sufficiently such that some of this ESG stuff is reconsidered perhaps in a slightly calmer fashion. And so I think there's a whole multitude of reasons here why um, I actually think in some respects it's worse than the 70s. I've been saying consistently rates are going to go much higher than people imagine. And everyone is sort of lobotomized CNBC complacency. Well, we got technology and we got this inflation and we got Amazon, we got the internet. How could you possibly say that? And I've said this before in this room many times. Yeah, that's true, maybe on a secular basis, but cyclically, we can certainly have a little, dalliance with inflation. But unfortunately, given the irresponsible, reckless policies of the Federal Reserve, and this gets to something that was, I think, mentioned yesterday in Michael Gaiad's room with Jim Grant. I didn't hear the whole thing, but Jim Grant was talking about the complete lack of discipline, the excess, the reckless fiscal spending, the reckless money creation. They've let the genie out of the bottle, and I don't know exactly where this is going, but I will tell you one thing. I know you guys laugh when I say this. I'll tell you the one thing I guarantee you we're not going to get. Whether we get runaway inflation on the road to Weimar, or we get a recession because this commodity prices go up. The deli sandwich goes up so much no one can afford it anymore. I don't know, but I tell you the one thing that's not going to happen, and that is Goldilocks is dead. Goldilocks is dead. There's an APB ad for Goldilocks, and no one's seen her, and she ain't coming back. All right, and that's a sort of mindless. No, that's a sort of environment where compounder bro on FinTwit with a freaking Sherwin-Williams, where input costs are low, they're jacking up prices because there's a housing boom, blah 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 blah. You get multiple expansion. You know the drill, okay? That type of stock. Again, it's a fine company, and I'm not current on the fundamentals, so don't come throwing tomatoes at me 6 from now. Once the stock is up, that kind of stock, you should run, not walk, as fast as possible away from that. And I'm kind of guessing. I mean, Dave, maybe you can look up the technicals on that. I'm sure you're going to say it looks horrible because of the relative strength, right? So the point of that is, when it comes to markets, rather than just getting a spitball session, it's inflation and stagflation, it's this, it's that. To me, the market regime that we're heading into at breakneck speed speaks very much to what Dave was talking about. I mean, Dave, from a sort of sector or factor perspective, I imagine you concur with that.
Absolutely, and Sherwin-Williams is well below the 200-day. It has a hook on it, but I think those are bear market rallies. I would rather own, when the market goes into a recession, historically, I look through the consumer groups and see what people will tend to fix their houses. Home Depot is better than you look at the home builders. It's not as bad, but it's not great. I mean, a recession hits everything, and that's where I go back to, as Hannibal Lecter said, you can only live off of relatives for so long. You will get sharp spikes, but when it comes to new automobile at an $80,000 half-ton truck, people are going to fix their car. You go to an AutoZone. AutoZone's at new relative strength highs. I mean, absolutely blasted out. People are repairing their cars. You're seeing that car sales are down. They don't have the parts to build them. People don't want to spend that money, let alone buy an EV where Tesla just raised the prices of it. And they raised it because of, good reason.
Exactly. And this goes back to when I was referring a minute ago to Jim Walker with the sort of ex post ex ante world, right? The world as we knew it is gone. It's gone. And everyone that tries to like look at the market, well, I mean, I don't care that rates just went from like 170 to 270 in the blink of an eye. Inflation's at 8% and going higher. We're still pursuing wildly, recklessly stimulative financial monetary policy. They're engaging in open mouth operations. They haven't done anything yet. And unless Jerome Powell discovers his inner Paul Volcker, Larry Jettle was saying inflation is going to 15% this summer. I believe it. Put that into your dividend discount model and see what comes out. I mean, Tina, Tina. I mean, Dave, you got the numbers. I'm just a professional bullshit artist, okay? But like, you'd be all these geniuses like, well, the equity risk premium. If you look at bonds and stocks, the yield on equities. I mean, dude, what is it? What is it, Dave? Like a third of. I got the numbers all mixed up now. We know the 64 portfolio is dead, but you plug in a 270 bond, when your dividend discount model set at 170, and you tell me what fair value is. You put in a 370, I think we're going there. All right.
Yeah.
So yeah, equities may look okay relative to the most overvalued condition that bonds ever been in the history of mankind. We had forget about generational. We had 5,000-year low interest rates. Normalize this, dude, and tell me what you think. David, thoughts on that?
The other thing, George, sorry to cut in on you.
No.
Dave,
you have to understand. This is a great line. You have to use this. I keep saying it to people. People like the way I moderate. Don't interrupt me while I'm interrupting you. David, you need to retaliate in kind. Jump in, please. The more the merrier.
Yeah. An article caught me the other day, about this financial engineering you're seeing feds do. The Bank of Japan owns 80% of the country's ETFs. I mean, that's akin to General Motors taking all their profits and buying their cars to report higher sales. I mean, I'm just baffled at, this financial engineering that they undertook to prevent a deep recession or a depression. And it's just going to result in the printing of more money.
100%. Okay, Marcellus, great question. Hang around, please. Let's go to Storm. Good to see you, Storm. What's going on?
Hey, good morning, Mr. Noble, O'Hare, David, followers. I had two questions for you, David. One's going to be really boring, but I've always tried to wrap my head around the Swiss franc. The other question is going to be on the future of gaming technology, maybe Microsoft's acquisition of Activision and Blizzard. Yeah, those are my two questions for you. I was just curious your thoughts. Like the Swiss franc, for example, we know currency is an unregulated market. Central banks, delve in there. They manipulate. But when you mention the U.S. dollar and the yen, and then I look at the Swiss franc and I look at Switzerland and I think about GDP, the size of the country, what do they actually do? What do they export? Chocolates and Swiss Army knives. Just wanted to get your thoughts on those two.
I actually have, a funny story. When Greece was going into bankruptcy, I'm sitting there thinking to myself, what the heck do they make? Like, and nothing against the Greeks, but I'm like, do I have a bottle of ouzo or olive oil? I don't know what they make. I don't know what the impact is on the world that they, go bankrupt, other than who's ever holding their paper. I mean, and that's what I think we have now. And you're seeing it in the commodity structure right now, whether it's nickel or palladium. People are getting blown out. Commodity traders, commodity firms, they don't have the capital because they bet the wrong way. And when it comes to Switzerland, I mean, Switzerland, the chart looks fine, but U.S. dollar versus Swiss. I mean, the U.S. dollar is gaining strength. I don't make anything out of it, however, because like you, I can't. The only thing Switzerland has going for it is you do have a lot of energy companies, and I traveled Europe quite a bit and spent a lot of time in Switzerland. You have companies like Transocean and a lot of commodities and mineral companies that have put their headquarters there, and they're just renting a PO box because they're very generous in their taxation of companies. So, I think that's one thing that can help them, because they do have significant amount of energy and material companies in Switzerland that are headquartered there. So they are doing taxation. However, it's much lower than anywhere in the world. So
yeah. So Dave, let me just chime in on that. As our Bitcoin Maxi friends would say, I think you really need to zoom out
and we didn't get into this yet. We will later, but there's a great piece I want to talk about from GavCal Research, and some others have written on this as well. And this has to do with the dollar. And given what's happened with the Russia sanctions and the fact that the Russians have bought a ton of gold, they're being cut off from the SWIFT system, blah 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 blah. Oligarchs are being cut off, et cetera, et cetera. The narrative basically runs, well, gee, heretofore you'd have a lot of countries pursuing mercantilist policies or other economic actors like sovereign wealth funds or oligarchs to keep their money in dollars, because that's sort of the world's operating system for money. It's as I hate that phrase, to clean a shirt and a dirty laundry. But now all of a sudden, you wake up one day and the Russians see that they can't get their hands on $300 billion they thought were theirs. So if you're a sovereign wealth fund or some billionaire sitting in Indonesia, the idea of keeping it in dollars maybe all of a sudden, wait a second, I don't know about that. And the problem is, if you don't like dollars, where do you go? There is no apparent alternative, obvious alternative. The RMB is not ready for prime time. Euro's got its problems. Swiss franc's tiny, et cetera, et cetera, et cetera. But so it's not clear where the money's going to go. But at the margin, there's going to be more money wanting to come out of dollars. Some of that will go into Swiss francs. Some of that will go into gold. Some of that will go into, other hard assets, prime real estate possibly, or timber, or God knows what. And so I think what's being lost in the discussion in the public square, again, go turn on CNBC. It doesn't matter. This just defines consensus. You guys know I hate the Cartoon Network, but let's just pick on CNBC. And they'll breathlessly say, well, gee, the yield curve is flattening and bond rates have gone up a lot, so the economy is going to slow. So that means bond yields should go down, and gee, it's inverted, and 9 out of the last 7 times this has happened, we've had a recession within 6 months, and blah, 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 so you should be buying bonds. They've been saying this now for weeks on end. And yet, rates keep going up and up and up and up. And I've been consistent in this room, and I believe they can continue to go up and up and up and up. Why? Because policy is still wildly stimulative. Real rates are still way too low. And now we have this bigger tectonic shift that's occurring. The idea that if you look globally in terms of the architecture of the world financial system, that maybe, just maybe at the margin, someone might want to own less dollars and own something else. Well, that means higher commodity prices. It means, which by the way, plug that into your idea of inflation. It means lower bond prices. And oh, by the way, do keep in mind that foreigners, the last year or two, I don't have the numbers in front of me, but foreigners bought hardly any bonds at all, or the amount they bought was down enormously from prior years. Oh, guess who the buyer was? Oh, it was U.S. government. Oh yeah, that's Q. Yeah, QE. Yeah, sure, they're buying bonds. Wait a second. That guy just came on TV, the Jay Powell guy, and he says, no, they're done buying bonds. They're going to sell bonds to the tune of 95, either between roll off or selling, $95 billion a month. So let me get this straight. Inflation is skyrocketing. Real rates are still incredibly stimulative. Foreigners don't want our paper. They just read, well, maybe holding dollar assets is not a good idea. And the Fed, who was buying all these bonds, is now is now become a seller. So again, to channel my inner Jeremy Irons from that movie Margin Call. So explain to me again why rates are at 2.7, the 10 years are 2.7%. Pretend I'm a small child or a golden retriever. So to me, talk about variant perception, and you got to cut me some slack. I'm not taking a victory lap, but I've been right on this. And for everyone who keeps saying the bond's oversold, dude, on the way up, I didn't hear all the tech momos saying, oh, you can't buy tech, it's overbought. You can't buy tech, it's overbought. So, run the movie in reverse. I think yields are going much, much higher. Dave, forward back to you.
Yeah, I again 280 is my, as a technician, I have to abide by rules. And I'm drawing a trend line on it, right around 280. If we pop above that and we stay there for, a week or two, I think we're going to see significant. I do want to add on the Microsoft. I was asked about the Microsoft question, so I'll just touch upon that. I mean, Microsoft is a tech stock, relative strength wise, it's breaking down. I mean, I think there's hard assets that are much, much better to own than Microsoft. The gaming space overall, I spend little time just isolating just the gaming space. But you know what? If we go into a recession, more and more people are going to play games because it's going to cost too much to leave your house. That's the only thing I would say.
Dave, I have to ask you a question because I don't have a screen in front of me, but someone is direct messaging me. Can you pull up? Is this an ETF? What is VET? Is that a stock or an ETF?
Oh, that's Vietnam ETF.
Do we? I don't know that we
believe.
want to. Do we want to spend time on that? It's a really, really tiny one. But is that what's the chart? Just could you
Or
answer?
no, Vermilion Energy. I mean, we're not associated with them, but yes, that I've come across the chart and it does look good.
It does or does not? I'm sorry.
It does.
Okay. All right. That answers that question. All right. Let's move on. We're going to do Jackson and then Weimar. Jackson, good to see you. And what's up?
Good to see everybody. Good morning. I'm down at Augusta getting ready to go into the Masters, but I just wanted to chime in. I know Alan Levinson's in here. He knows what I'm harping all the time. And George, you've heard it before. Going back to what David talked about, this is all top line. I know I beat this dead horse, but I'm telling you right now, I'm at Starwood Capital, and I can tell you I'm on the PE fundraising side. Everyone and their brother is desperate for yield in this environment, typical end of cycle behavior. And I can't do anything because everything is fucking top line. David, I'm telling you right now, I can get $1,800 a night for a shitty, gorgeous room with South Beach, but your experience has been dumbed down. I live in steakhouses 3 days a week. Levinson knows. What's the first thing the waiter tells you? Well, the kitchen guy's not here, etc. So all of this is top line. Margins and multiples are dead.
Yeah. And to touch off on what George said, I saw an article the other day. I want to say the number was around 60% of funds have adopted ESG and are all underweight energy and materials. And I talk to my clients and they say the same thing. They own one or two energy or material stocks. Why? Because it's such a small portion of the market. And I'm sitting there going, yeah, but if it's 3% going to 8%, like you're going to sit there and dabble in tech stocks.
Yeah, but Dave, let me interrupt you. Apple's what, 7% of the S&P?
Yes.
Okay, so Apple's basically worth almost twice energy. So they're more worried about what to do with Apple than they are energy.
That's correct. I just did a calculation before the call. The top 50 stocks in the market account for 54% of the market cap. If you want to talk about a nifty 50 environment, we're in it.
And by the way, Jackson, your comments earlier about energy, I mean, and David, it's even worse. Like you look at the data, some of the prime brokerage data, and I wish Jeff Garbaz of Erlanger works with Phil Erlanger from Quantitative Partners. He's usually in this room. I don't see him right now, but just mind-boggling. The last couple of months, there's been, I think, like net selling or shorting of energy stocks. Like it's the only group. It's the group which has been the best. And if you're telling me, like, all the analysts are getting inbound calls, everyone's piling in, you'd say, okay, at the top, My Life in Times by George Noble to Dave Nikoski, right? But no, it's exactly the opposite. They're not drinking the Kool-Aid. They're not. So this has got a long, long way to go, in my humble opinion.
Yeah, it's much like the ARC funds, raising money when it's down 50%. Like that doesn't. The bear market's not over. I mean,
totally.
You can't
Not even
keep
close.
taking in funds when you're down.
Totally.
50%.
I mean, Dave, how's the saying go? What is it? The lesson shall be repeated until learned. These guys haven't gotten the memo yet. So anyway, all right, let's move on here. So we're gonna do. If anyone's got questions, I see some friends in the house. We got to get Mark Newman up here. Hold on. I see Cantro's hiding in the third row. So is Sohei. We got Alan Levinson in here. We got Schmuckatelli. We got Andrew in here. We got so many good people. L'Enfant all come up. I was hoping to do a war room sometime later this week, but if L'Enfant or Schmuckatelli just want to give us an update about what they're seeing, that would be great. So the more the merrier. So let's go to Weimar first, and followed by Mark Newman. Weimar, good to see you. What's up?
Hey, George. And a shout out to the Canadian oil mafia, of course. Well, what I hear sometimes is people who actually believe the BLS figures on unemployment. And what I believe, especially in the market coming, is that you have to dig deeper in numbers. Of course, if you're just a day trader, that's a different way of thinking. You just chase whatever goes up or down, whatever. But if you look from a long time perspective, as I do, I think it's important. Or if you would, short something, then that you really have to research. So I find it amazing that people believe the figures of their own government statistics. Because I hear someone say, yeah, in the summer it will be 15%. It already is 16.5% if you believe the shadow stats. And that's, well, I've been following these numbers for 2 decades. They're pretty solid because they keep the basket fixed. So if you look to the inflation chart, you're comparing apples with pears because every year something changes with the CPI. Lately already changed calculation. So if you want to compare apples with apples, you have to look to a fixed basket. And I can be a bit technical, but I think there are probably a lot of guys getting it. Same with unemployment. I hear it's maximum employment. No, it's maximum unemployment. It's 25% real unemployment because in the U6 they don't count people who don't look for work anymore. So the great resignment, if you look to the website shadowstats.com, I really recommend it. So the thing with maximum unemployment is absolutely bullshit. So what I think is that the problem isn't there aren't enough people, but there aren't enough people on the right place. And I think what we can expect are markets that are extremely inefficient by all kinds of things like ESG, common price controls, all these kinds of things. So I think if your time frame is a little bit longer than a day, then you probably think very, very differently about what is coming. And I think if you look how fragile the international monetary system is, you probably get more of a 40s scenario, not a 70s. And well, at least that's my take. And it's always easy when it's like selling. When everyone is rich, that's easy. And it's much harder than to sell in bad times. So it's the same as with buying. What you're gonna pick, and then you cannot trust these numbers, which are with hedonics, the inflation and unemployment. These are very important things. I also think it's important to understand, and it's not me bashing America. I love America, so that's not the issue. But if you look to America like an emerging economy, an emerging market, then things fall into places because it's pretty normal there that bonds go higher, inflation higher, and stock markets plummeting. That's normal in those conditions. And the problem is, I find many people guessing. Tina, there's no alternative. Then I think, well, you have to get your head out of the sand because it goes slowly, step by step. Everyone thinks that tomorrow it's about tomorrow. No, the dollar not being so dominant anymore. It's not about tomorrow. It's about slow changes. And the other thing is, it's black swans. We have many black swans, and these things, how the policies react on it, are constantly making the system more inefficient. And I think people should stop, talking in black-white terms, more in how it slowly goes into one more inefficient direction. And I think with energy, it's very interesting, and also with hard assets. And I saw it coming, and I was 2 years ago I went into it, and I saw yield curve control coming. I saw many things coming because I have a longer timeline, and I have time to think about this. But if you just day trading, you have a totally different perspective on things. And I sometimes find that day traders are pretty dominant, and that gives a bit like whatever the market sentiment is. But if you want to look ahead, you have to dig deeper. You don't need only to look to graphs. Like what AB was saying, you have to research. You have to what's happening on the ground, what's really happening, and what these numbers, if they're job reports, what kind of job, what quality, which age, these things matter. So this is not a time to only look at graphs. This is time to look at fundamentals because they're coming back. And of course, there's a big fight against these fundamentals, but the fight becomes harder. And I mean, Biden, he said, Powell will, he's the one. He will do inflation. But there is a hidden threat that if he doesn't, then the politicians will do price controls. They don't work, I know, but they work if done short before. If you fix the price. So that's what I was saying.
Yeah, Weimar, brilliant. Love what you say. Really appreciate your comments. Do you have is there a question you want to ask Dave, or I mean it's fine, you don't have to.
I want to ask how he thinks, how he if he looks back in financial history, how he thinks that the 40 scenario is an option, and how he thinks that maybe the Fed won't ask collateral, so it's a kind of QE by banks, maybe a possibility, and maybe even the Fed buying ETFs if the whole stuff comes down too fast. That's a question, and the other is how he thinks about my emerging markets idea. That the dynamics have changed, and
excellent, perfect. All right, Varma, that's great. So, Dave, please unmute yourself. You got that, Dave? I don't know where he is. I'll answer the part about.
Hey, I'm here.
There you go, Dave. There are a whole bunch of questions. You hear that, Dave?
Yeah. So, yeah, I mean, my career is on technicals and not looking at what the government does. I certainly do enough reading. When you talk about the 40s, being that your name is Weimar, I assume you're the Weimar Republic. And maybe I'm wrong, but
yeah, you're wrong.
Okay.
You're wrong.
All right. So, there was some comments out of Germany that, if they continued with these sanctions on energy and that type of thing, that they would be back at the Weimar Republic. So that's why I jumped to conclusion. So, you know what the definition of assume is. I wouldn't doubt that the Fed is trying to engineer a soft landing, and they're trying to keep the spreads of the 2s and 10s apart. And we'll know, months from now. We always find out after the fact of what finagling they're doing. In terms of the emerging markets, like I said, you can pull up the EEM index. The problem is it's heavily weighted towards China. There's a number of emerging markets that look great. Guess what? They're all commodity oriented, and that's giving me at least a degree of enforcing what my view is in terms of the inflationary standpoint. When you look at, I look at currency crosses. again, the US dollar index, you're comparing it to all of the worst countries in the world right now. Whether it's Europe, whether it's UK, whether it's, the Japanese yen, they own 80% of all ETFs. I mean, I'm looking at, Africa. I mean, you look at the gold stocks in Africa, they are absolutely on fire. The only place they're not on fire is here in the US. And I think everyone's focusing too much on that US dollar index to determine inflation. I think that's what's holding gold down because,
True.
again, we're the strongest.
Yeah, so let me just add to that. So Weimar and by the way, Dave, just so you know, Weimar is one of the smartest guys that comes in this room. He's actually Dutch, but he causes trouble by having this Weimar name. So you're not the only guy he's
All
confused.
right. Well, I'm sorry. I
Yeah,
apologize.
no, we always
That's
laugh
fun.
at it. We love having him in here. So Weimar, I would just say when you talk about the 40s versus the 70s, I think what comes to mind, I think what you're getting at is the emergence of the dominance of fiscal policy over monetary policy. And so that if we get a situation where is increasingly use of fiscal policy to sustain economic growth, take most recently what's going on with energy prices in Europe and other places. We have governments now offering checks to offset the higher cost of energy. You've seen it in various European countries. I think in California they're doing it. They were sending gas taxes here, there, and everywhere. So you get this situation where the higher inflation is actually subsidized by further government fiscal policy. Yes, it could look very much like the 40s, and so you will get this increasing inflationary spiral. And so, yes, I completely agree with you. It's entirely possible. I don't like putting words on things because words have different meanings to different people. But if you're just talking about an environment where inflation is higher than lower, where you want to own, where real incomes will be challenged, where you're going to want to own price makers as opposed to price takers, I think the investment strategy that follows out of that is pretty clear without putting a name on it. And so, but I agree with your point overall, and all of it comes back to, again, no matter how this plays out, runaway inflation, recession. Door number one is runaway inflation. Door number three is recession. The one door you're not going to get to knock on is Goldilocks. Goldilocks is gone. That's just not coming back. Thanks for that, Weimar. I really appreciate it. Mr. Newman, my friend, how are you? What's up, man?
Hey, George, how are you? Hey, everybody. Really, thanks for having me here, George. And I tell you, this place every week, there's just something new you learn, and a new great expression that you can just think about a lot. And I want to just tie a couple things together here real quick. Weimar mentioned some interesting things, right? He kind of discussed in the employment stats how the government's sort of crowding out the employment market, right? Because of the benefits and these kinds of things, they're incentivized not to work. I thought that was really interesting point he made there. And then he talked about also the import-export thing, right? Like the U.S. tries to export its way of life to everyone, but what really has happened is we've imported a lot of sort of third worldishness to us, and he highlighted that. And it's super important when we talk about this inflation thing. But I want to tie it together a little bit because, George, you and I lived through the 90s of Japan, right? And the one thing I will say very recently that's going on in my head is in Japan, it got to be so that they managed the assets, not the economy, right? So the Nikkei was more important a barometer of their policies and not necessarily the economy because, they pave the rivers, they, tear up the rivers, repave them, build the streets, stuff under construction forever and ever. And so now I would think we have to be really cognizant of that here, where it seems like a lot of the Fed policy is obviously to protect the assets, less about maybe the economy. And it's just like an ancillary thing if the economy works, whatever, but they really want to protect those assets. So I think we need to think about that as things go forward. And I tie that a little bit together because, there's going to be a point here at the end. I just want to tie it all together. Someone asked me the other day, about what if we just lost 20, 30, 50 bips a day for a long time? And I definitely think the death by sandpaper type action that we saw in Japan in the 90s, right, George, is one glide path. I don't think it's the only glide path, but I think it's one glide path we can think of. And then Now to sort of bring this all together, George, you mentioned that 5,000 year lows of bonds, right? You know, but I mean, look, let's talk 40, 50 years, right? What sort of early 80s, let's call it at least. And then the stock market, right, has been on that tear for, I don't know, at least 20 years, but whatever, we can play around with the numbers. But the commodity market, like we've discussed here, and people are seeing this, if you think about how maybe bigger cycles run, and this is sort of where I'm going to with David, the long-term, super long-term bond market, okay, 50-year, 100-year, super most expensive ever, whatever we're calling it. The stock market's pretty ridiculous, right? We've had 2 or 3 or 4 bubbles in a short time, which is part and parcel with what, you know, Japan policy type behavior creates, right? You never fix the bubble. You just kind of short-termism it to death. So the question is, can the commodity patch now be that one to take the baton in the not, we're not obviously near a bubble yet at all in commodities, but that's sort of the broader cycle. Bonds are done, game over. And then, so now here we are. David, the question is this with the markets here, right? The glide path of death by sandpaper, that's one thing. But are we all talking about the gap risk here? And when I say gap risk, I heard, David, I thought you said 280 was your target in the 10-year. I don't know. That seems a little like, and maybe we think rates are going higher in general. That's the gap here. The gap risk, right, is that commodity prices really go bananas. And that's the opposite of the death by sandpaper type downside.
Yeah.
And so I just wonder on the, are we talking about a policy-driven death by sandpaper versus, oh my God, we wake up one day and there's Arab Spring food riot, and all of a sudden, gap risk everywhere on our commodities. I wondered if you had insight on that, and I generally think the commodities have the baton for a while here. Your thoughts?
Yeah, and when I talked about the 280 is my level, that's the level at which you break the long-term downtrend. It's not my target.
Gotcha.
Okay, so
yeah.
You know, I would be in the same boat with what George is saying. If we broke above 280, but looking at different trends, again, the longer the trend that you break, something breaking a 40-year downtrend is much more important than something breaking a 2-week downtrend. So if 280 is taken out, I agree with George. I agree with George now. It's just that I'm a technician. I have to say, this is my line. If we come up to 280 and back off, everyone that's saying that there should be, a bond rally is going to come in and say, I told you so. It's kind of like calling that March bottom. It's great if you can do it. If you're a trader, that's wonderful. If you're in the view like I am, you could, play that rally, or you could have just bought utilities or staples and you wouldn't have had to turn back, right? You wouldn't have had to time it. You would have already been there. And that looks a lot better than what we are at now. I do think that if you have inflation, the worst sectors to be in historically for inflation was utilities and staples. And that's why I go back to, Hannibal Lecter can only live off of relatives for so long. It just, you're going to sit there and time, 2 or 3 week extensions of relative strength, and you're going to get, knocked around, and it's going to feel like you're in tech. And that would be my concern about looking at.
So, Dave, let me frame Mark's question a slightly different way.
Okay.
I'm sure you've done the chart. We've all seen it. You see those long-term charts of equities versus commodities.
Yes.
Okay. We know equities, grow, so they should outperform over the long run. However, the rubber band has been stretched so far, and I'm not talking about on a quarterly basis. I'm talking like on a multi-year, decade type basis, where commodities are so underpriced relative to equities. Doesn't looks to me. Let's talk about charts. Turn your brain off. Okay, it's trade what you not what you think, and forget about Mark's narrative where he's convinced himself, and I agree with him because we talk to each other all the time. Forget about a bullshit narrative. If you just take a look at the chart and you look at commodities versus equities, doesn't it look to you that chart's set for a sustained period of outperformance for the next few years?
Yeah, we are in a secular bull market in energy and materials. It is not cyclical. It is a cyclical within a secular downtrend that's reversed. So it's a secular bull market. I think it's a number of years of outperformance.
Oh,
Hey,
just a commercial message from our sponsors. Newman, I'm going to try a joke here. You got to help me.
okay.
So we have a live trading room where Mark Newman's going to help you. He's looking for setups, and he's got his weekly options, and he's got a Discord for $99 a month. So we had the pick of the week. So don't listen to any of that bullshit Nikoski was talking about. So Mark, you got some picks for us, Mark?
Wait. Well,
No,
little,
Mark, I didn't try. I'm busting you. I'm busting on you, man. Right? But the main thing is the real serious point I'm trying to make is that shiny object, the shiny object du jour, whatever knucklehead thing is going up or down 25%. And then you got the Nigerian brothers coming on and say, well, I'm looking for the weekly set. There's a lot of paper coming in here and blah, 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 blah. I think those guys took one too many hit to the head on the football field, but I digress. I got to be careful what I say because they're bigger than I am. They can beat the hell out of me. And anyway, I mean, don't lose sight of the big picture. And Nikoski's got it. You got it. Okay. That's investing. All this stuff on Twitter is all bullshit. All bullshit. So anyway, all right, enough of my rant. So we're gonna do Gilberto and Trend Trader. Gilberto, good to see you, man. What's up?
Good to see you, George. Hi, David. Really appreciate your insights. I want to provide one observation, one idea, and one question. The first observation, and to David, I live in an emerging country, and I think what Weimer said set the stage for what's going to happen. For the first observation is that for each one of us who has access to market uh, brokers accounts and we can access many instruments to hedge ourselves, there's got to be, I don't know, hundreds and hundreds of thousands of people who don't have that degree of freedom to hedge their wealth against inflation. But don't fool yourself. Everyone who is an active person in the economy is seeking ways to hedge themselves. And what changed for us are the degrees of freedom. Give me a second. Gracias, mi amor. So what's happening is that if you go to your local bank in any emerging country, and by the way, our populations as emerging countries overpass by far those of United States, they offer you dollars bank accounts and euro banks accounts. That's your that's your degrees of freedom, and you can buy local real estate. So what's the observation is that everyone is buying dollars because their own currency are shit, and that's their first response. That's the first observation. Second, I said I had an idea. For my past experience in emerging markets, my idea is that the best trade will be long dollar. That's going to be by far the the nature of the things that are going to happen because rates are going to increase, dollars are going to be in demand, and that's going to affect the whole economy. The question I have is what's going to happen to the US economy if you add up these three situations: rising dollar, rising rates, and less employment, because it's going to be harder for everyone to start a new business, and of course, employment is going to go down. That's all.
So but, but David, let me take that one because I know you're looking at the charts. I'm the one spewing out the narrative, so that you can put a narrative with the chart. So Gilberto, you what you're saying just ties back into we've talked about many times in this room, which is the triple demerit scenario. You have rising interest rates, rising oil prices, and a rising dollar. Okay, that is bad for risk assets. Period. All right, and so it leads back to the phrase I keep repeating, which is equities to me, risk assets to me, represent return free risk. Return free risk. Little upside, huge downside. David, do you want to add to that at all?
Yeah, um, in times of uncertainty, everyone heads to the U.S. dollar. I mean, the war breaks out, everyone piles into the dollar. At some point when that reverses, any foreign holders of U.S. equities, and will be, in my opinion, will be in the tech correction. And let me give you a scenario, perfect scenario. So back in 2000, after the bubble, the dollar remained strong. In 2003, you broke that uptrend. The U.S. entered a severe correction in all sectors. During the technology correction, you could have bought an industrial stock and you would have outperformed the market significantly versus tech. And so when I hear that someone in foreign countries just wants to own U.S. dollars, that's the impetus to me that the U.S. dollar is obviously still strong. But when that reverses, you're going to take a lot of foreign equity holders that own U.S. equities out of the market. And when they do that, that's when I think you get the correction. That's much more significant, and it's across all sectors.
Hey, George, you got one more second for me? It's Newman.
Newman, you can talk whatever you want, man. What's
So
up?
that gentleman who was just on there speaking before David, I want everyone to think about what he said, because it was super insightful and valuable. When I talked to my macro guys for these past 25 years, and I laid it out to them, I said, look, the dollar and gold could be stronger. And he said, Newman, I hear a lot of your things about energy. I love that, blah, 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 but I don't buy the dollar and gold stronger. And if you think about it in what that gentleman shared, and he sounds like he's from an emerging market, right? As he said, and just I'm talking.
Newman, he's from the Dominican Republic. Yeah, keep
Oh,
going.
the DR, love the DR. What a fantastic place.
Yep.
Anyway, you think about it, yen, euro, and dollar. If we go from the one aspect first of like the army strengthens the currency, so to speak. If we're talking about a race to debase, I'd rather have the dollar over the yen and the euro based on army strength. Okay. And then if you think about it, as that gentleman pointed out, there's only a few choices. So the dollar will be the cleanest shirt in the dirty pile for a while. And alternatively, gold will be there, right? If not everyone can get dollars. So that trade, that is where gold and the dollar can do well. And I think that was super important what that gentleman shared. And I really thank him for that.
And Mark, totally. And as you and I know, correlations change over time. And the trick is to figure out when it's changing, what regime you're in. And we've seen the dollar and gold prices already going up. So what you're talking about is not some hypothetical. It's already happening.
Yeah.
You very cogently lay out the reasons why. And I personally believe this is going to continue to happen.
Mm-hmm.
So, no, we're on the same page here. And again, to invoke one's inner Michael Steinhardt, I mean, I know, Mark, you know this, but Michael Steinhardt always had this line of it, variant perception. What do you observe? What do you believe that it's different from the market? And what Weimar was talking about, when you're echoing, we're talking right here, right now about gold and the dollar, or, my point about rates continuing to go up much higher, even though the yield curve is flattening. I mean, it takes two to make a market. That's definitely a variant perception. And so I think there's a lot of money to be made here on these views. And what I really like about what you're talking about and Weimar's talking about and what I've been talking about, aside from the fact I love to hear myself talk, is that it is such a minority viewpoint. It is such a minority viewpoint. Go back to the energy for my Canadian oil mafia friends in the room. I see Marcellus he keeps hitting the smiley button. I say this affectionately, Marcellus. I mean, look at how lonely the journey's been. Even now, people are still they're shitting on energy.
Because George, the genius idea is to now redouble really hard on that renewable trade. That's so
exactly.
So look, I have to head out and do some things, but I wanted to just say that this room always continues to be just a great spot to be in for a couple hours on the weekend. And on this ESG subject matter, there's a lot super interesting going on. And I think there's more to be discussed on this, and there will be soon later.
George, before Newman goes, I want to share with him one last idea, and with everyone who is here.
I'm here.
If you go to any source of info about how easy it is to buy dollars in emerging markets, you will amaze yourself how difficult it's starting to be. Banks are limiting the amount of dollar they are selling to common people.
Wow.
Super. I mean, so guys, anyone in this space, please understand how on the ground important that kind of data point is.
Yeah.
You're never hearing that on CNBC or CNN ever.
Newman, let me interrupt. Gilberto. You're talking about it's hard to buy dollars in EM. So what Mark really wants to know is a cross trade. It's hard to buy dollars in EM. Meanwhile, in the U.S., it's becoming increasingly difficult to buy gold. how hard is it to buy gold if you wanted to in the Dominican Republic?
Well, we have Barrick Gold here. We have the third biggest gold mine in the Dominican Republic, and we can't buy gold if we don't have a broker account and go to the GLD ETF and buy shares. I think that's tells you everything.
I don't think your daughter likes gold. At least that's what I'm hearing from her.
So this is just so everyone knows on the space. This is audio gold as far as I'm concerned for the weekend. Really.
This is Newman.
It is.
And Newman.
Yeah,
That's
man.
always they say, like, one thing, just one thing. Like, if you just got one thing from the room, this is it. This is the money page right here.
It is right there. Anyway, everyone have a fantastic weekend, George. As always, love this place, and I will
Thanks,
see
Mark.
all
Come
soon.
back anytime, man. Always welcome.
Thanks. Take care, guys.
All right. Say, here. I want to turn it over to you for a second. I mean, you've been sitting quietly. You're co-hosting with me. Any thoughts, comments, reactions? And failing that, who do we get up next to speak? O'Hare, floor is yours.
Hey, George. Yeah, good morning, guys. Fantastic as usual. A lot of good, insightful things this morning. Kind of what I've been thinking as I'm listening to you guys is this kind of overriding theme of inflation, asset prices, gold prices, oil prices. I mean, food prices. I mean, geopolitical risks. All this stuff kind of this gels together, and this is something we've been talking about, George, for months now on a lot of these spaces. And what I like to see is I like to see more. I'm encouraged to see more and more spaces like this discussing these topics, because we went from a lot of spaces a year ago discussing just nonsense, YOLOing, like you were saying, with all this kind of just COVID related stuff, to now discussing the real issues, which is runaway inflation, government spending, those types of things. So I just wanted to say, just real quick, from in my mind as I'm listening to you guys kind of talk about this, kind of 3 or 4 things, overriding themes here, which is, high inflation, runaway inflation, stemming primarily in my mind by government spending, runaway government spending, unfettered government spending for, literally decades now, that's accelerated over the last, 3-4 years. Keeping interest rates low, keeping the cost of money very low, high leverage. Someone mentioned earlier about the fact that consumers are better off today than they were, in past recessions or past cycles where we're heading into a recession. I would disagree. I would disagree. I think there's a lot more leverage in the system today. It's just been masked over. It just looks better, right? It's the same pile of shit. It just looks better. And so I would just say, the pressures on inflation have been building, and they're not just, I think a lot of these spaces, a lot of people are talking about, well, it's just, transitory because it's just supply chain issues. It's COVID related issues. While that's a large part of it recently, those pressures underneath have been building for a long, long time. And so I would just submit to people that COVID brought out the inflation that was already bubbling under the surface. It just brought it up. It just brought it up to the surface. Now, putting that genie back in the bottle is going to be extremely difficult, if not impossible. And so a couple things are going to have to happen. 2 or 3 things are going to happen, whether simultaneously or, one at a time. But government spending is going to have to be reined in. I don't see that happening anytime soon. Taxes are going to have to go up to pay for a lot of these deficits. That's not going to happen anytime soon. So if government spending doesn't get reined in, and not just in the U.S., but just abroad in general, Canada, Europe. I mean, somebody made a comment that you still have a lot of this stimulus in Europe, just unfettered stimulus, just keeps going and going and going and going. That's we understand that this is not going to work. It hasn't worked. It just kind of puts a band-aid over the problem, which is again leverage and government spending, right? When and you could just print your way out of it. And so I would just say we either taxes are either going to go up, government spending is going to go down, or they're going to just keep printing into infinity, which means commodity prices are going to just balloon. So
100%, 100% here. All right.
But so anyway, very interesting. So it's a great room.
That's great. So let's just do a quick reset here, and I really would like to focus questions more to Dave Nicoski, because we're very fortunate to have him. We can spitball all the time we want about macro, but I really would want. I don't want narrative. We've done enough of the narrative macro questions.
Let me ask you this, George, and let me ask Dave.
Yeah, go ahead. Go ahead.
Let me ask you this. So everybody talks about how this is kind of a we all want to believe that kind of past this prologue, that we can look back into the distant history. And David, you do a lot of research on on technicals and charging and so forth. What are your thoughts on kind of, we are in uncharted waters here, so using past experiences, whether it be even as recent as 2014, 2015 boom and bust cycle in commodities, going back to 08, 07, the period between 2000 and 2007 in commodities and value stocks, value and commodities outperformed and then crashed. Those periods and many others, in my mind, are a little bit different, because today, as George pointed out earlier, you know, it's we're dealing with a whole different animal here. What are your thoughts on kind of looking back and utilizing some of that information to build your models versus kind of creating new ones based on the realities of today?
Yeah.
In other words, how good are those roadmaps, those inputs?
Well, everything's not always the same, so you can't find a perfect place in history that we had record low rates, we had a housing boom such that we've had. I mean, the best example more recently would be that 2003 to 2007. And I don't know if he's in the room. I haven't looked, but I was at a meeting in Boston, back in 2007, and I said Fannie Mae's breaking a long-term uptrend. I said it looks like they're going to go under. He looked at me straight in the face with expletives. If that effing happens, we're all dead. you know. But I think that period, I think we're going to see massive financial fallout. I think that everyone's positioned wrong on the market. And when I say that, there's always something, where there's one cockroach, you're going to find a lot more. And I think that period of from 03 to 09, I couldn't have told you we're going to hit, 140 some dollars a barrel. But it was evident, when oil was at 20 that you were breaking long-term downtrends. And that was the time to, do your shopping. With rates going up. Yeah.
And David, on that note, I mean, that's absolutely, I completely 100% agree with that. Then you have to add in and kind of overlay the last, say, 7 years of ESG booming, right? This lack of investment in the energy space, just in the commodity space in general, whether it's mining for non-ferrous metals to precious metals to food and fertilizers, anything that was considered non-ESG friendly was thrown out. And so couple that with what you were just saying, because I think that problem now is compounded times 10 because of that lack of investment. Somebody, I think it was you or someone else, made a point that when you look at the S&P 500, the broad market gauge, and you look at the energy weighting, for instance, in that, it's less than 3% even today, even with this run.
Yeah, can we just get off that? I think we were kind of like repeating ourselves here. I don't mean to be rude, but there's another question. Great. We're kind of circling here. All right, so let's move on. So quickly, so Jackson, if you had a quick follow-up, I wanted to recognize Jackson for a follow-up and Weimar for a follow-up before we go on to other questions. Jackson, you got a follow-up?
Yes, just one quick one for David. I know O'Hare seems to be the only guy that I can find around here. I know there's a few others that are tired of this. The Fed can't, the Fed won't, et cetera, et cetera. At my position, I don't care because they're so far behind the curve. We're on our own finally. Do you agree, David?
I think we are so far behind the curve that it's ridiculous. I mean, they would have to do QE again to save the market, and that's not going to happen.
Yeah, I mean, the line I keep using is they're so far. And I was quoting this 3 months ago. They're so far behind the curve they can't see the curve. And the Fed doesn't really do anything. They just follow. I mean, the market's going to do it for them. So they can carry on with this open mouth operations. The market's going to do the bidding for them. Thank you for that, Jackson. Weimar,
100%. I was just wondering, can you give my mic to Alan Levinson? I don't know how to do that.
Well,
Thanks, guys.
Alan's a very good friend. I'll get him up here if he'll talk, but he's just a shy guy. So Alan's a really good friend. So Weimar, do you have a quick follow-up, Weimar?
First, I like the remark of Jackson. The other thing is because next to my long timeline stuff, I'm occasionally dabble a bit on the speculative. So my question is, nothing macro at all. If David can give his quantitative short-term outlook for financials, because I think that might be very interesting. Because I'm curious also about if someone's in the room who can make share his qualitative analysis on the short term on the financials. Thank you. That was my question.
Yeah. So, I mean, we're underweight financials. I don't like them. I think they're going to get worse before they get better. Like I said, I believe that the Fed is most likely trying to engineer, the 2s and 10s spread to keep them positive. But again, when I look at mortgage-backed securities, ticker symbol MBB on an ETF, for instance, again, you're getting close to those 2008 lows, and guess what? We haven't seen any houses come on the market yet. I think that's only going to get worse. I think that we're going to have again some fallout by the brokers. The brokers are always the telltale signs that something's wrong. And you look at Goldman Sachs, Morgan Stanley, or Citigroup, they were peaking well before the other financials. Remember, the broker, the investment banks, they're the ones that do that paper. Your local bank, is packaging mortgages and selling it to someone else.
Right. And David, you really put me this. I remind everyone, I've got a pretty good sight line on real estate because my partner is very much involved, big real estate producer here in Westchester, and so far everything's really strong. However, I tweeted this out the other day. Go look at my Twitter feed. I'll retweet it. But one of these sharp guys was pointing to changes in inventories in certain markets where you have more readily available supply. The problem with Westchester is just there's no supply. But in some of the Sunbelt states, you're starting to see inventories expand quite significantly. And that might be a harbinger of we're at a top or approaching a top. The other thing I would say, and Shrub is in the room, I'd be great if Shrub would come up and talk, but he had spoken a few weeks ago about how in Europe, a lot of the oligarchs, the Russians, the high-end Russian guys, they're the ones that were top picking everything. And he had mentioned how all of a sudden, like, that stopped. And so that may be sort of the shot across the bow. So we may be on the precipice of that. So I see Shrub's up now, but before we go to Shrub, I'd like Marcellus for a quickie, and then we're going to get Shrub in here. Marcellus, you got a follow up?
Yeah, just I know David is a long-term chartist, and obviously we're in the same kind of boat as far as where we're thinking with commodities and oil. But if you look at that like 20-year chart on oil, I know we've moved up above the top of that trend line, if you will. I'm kind of curious of your thoughts. Do you think that there's an impetus to possibly drop back down a little bit into that channel, or all of the current issues and more, say, 3 to 5 year issues that we have right now are going to support this continued move above that trend channel?
Yeah, again, when I call a secular bull, I think the long-term trend is up. My biggest concern is that, on a near-term basis, I mean, you could pull back to the 200-day on a, market correction and the belief that there's going to be demand destruction. But, if you looked at the fundamentals and I told you drilling is down 43%, when's the last time that's happened? And you're going to go back to 1998, okay? When oil hit $11 a barrel. If you're a CEO, you are looking to sell assets. And again, with so many companies bankrupt, how many people in this room are willing to move out to Williston, North Dakota to take a job in the oil field? Right? Everyone's left there. They've already relocated their family. They're not. No one's jumping up to get into the oil patch business because everyone believes it's cyclical. Because look what happened in 07 to 09.
100%, David. Not only I believe it's cyclical, I know we have the Canadian oil mafia is not here in full force today, but maybe Marcel can speak to it or whatever. But the sort of shaming that goes on, it's like, oh, you're gonna like go for a company that's got a carbon footprint, blah blah blah. So no pun intended. It's just pouring gasoline on your fire. So you're 100% right. Dave, I have a question for you, which someone else is asking, but they can't get their mic to work. This is a great question. I think you'll really be helping a lot of people in the room with this question. So it comes from someone who is, I guess, a slightly less experienced investor. And this is a great question, Dave. Hey, George, thank you for the fantastic spaces. Could you ask David the following? How would you recommend a beginner learns about technical analysis? is extremely difficult to find a reliable source, and it seems that people look at one chart and see different things. What would be 1 or 3 topics or books or courses
Yeah.
that would be the right way to learn it the right way?
Yeah,
so that's the question.
Well, there is an association called the MTA, Market Technicians Association. That's if you want to pursue a career in that, that's the place to go and learn about it. It's a test, much not as fanciful as the CFA, but probably some of the better books out there is like John Murphy, well known, writes a great book, does an intra market analysis book as well. Pring is kind of the godfather of technical analysis, PRINGE. And you're right, technicians will come up with different things. There's a handful of technicians that will focus on intraday trading or the next move, and not look at the big picture. You don't have a tendency that some people don't see the same pattern. Some may see a pattern one way and some may see another, but they're not getting the actual inflection of those lines. So they might decipher it and say this is at support, and someone else says this is a descending triangle. Much like I'm looking at oil right now, the long term's intact. You could have a descending triangle or a bullish flag. Now I don't know which one it's going to be until it hits those lines.
So David, you're saying a good place to start would be to go to the MTA, the Market Technicians Association. That'd be a great place to start.
If you want to get in the business, that's where you'd pursue to get your MTA
right,
certificate.
And then some of the older classics like Murphy or
Murphy,
Edwards and McGee, or any of the other ones you might want to mention.
Yeah, Edwards and McGee is a great book. Again, there's all kinds of different philosophies on technical analysis. There's not many. I don't know of a source that's written on relative strength like what I do.
Right. No.
Okay.
You got the secret sauce. That's awesome. All right. Let's move on. I want to keep the pace up. Weimar, if you have a quick follow up, I'll allow it. But otherwise, I want to go to somebody else. Weimar, you got a question for David? Weimar?
On the question of your what was just sent to you, I have just a general kind of rule. It's better to not have one story based on one graph, but to have to try to find many graphs from different angles on the same thing and analyze those. I mean, it doesn't only mean for technical analysis, but I think that's just a proper way, because you have many people who look to one graph and they have some kind of narrative about it, and then you talk about inflection point, but the problem is often that there are also other graphs, and if you don't look to them, you might come to different conclusions. So I think that's just just a general remark for that time.
Yeah. If I can interrupt, 100%, Weimar. That reminds me. Someone else described it the other way. It's sort of like if you're looking for you have a medical condition, you have a health issue, and you go from one doctor to the next, looking for the opinion you want. You can always find a doctor if it's knocking enough doors. You can always find a doctor that gives you the supporting opinion. Similarly, you always can find the chart that'll support the opinion that you have, but that's not the way to run it. I completely agree with that, Varman. It's a great point. All right, my friend Shrub.
Yeah, and
Shrub is one of.
George.
Sorry, go
how's
ahead.
it going?
Good. So Weimar, if you could mute yourself, please. Shrub, good to see you.
I just wanted to give you one data point on what you mentioned on the high end here. So I got a fresh data point, one very high end villa. The discount to the, so he's a Russian guy trying to sell. The discount to the pre-war price is about 40%. Super prime, very sought after real estate.
Hold on. Shrub, hold on. You said 40% discount to pre.
I'll tell you the number. So he wanted 16 million euros.
Yeah.
Then he was going to settle for 13 before the war, and now he wants 9.
Really?
And there's no buyers.
Now, let me ask
and
you
there's no buyers.
Okay. So Shrub, stop. This may be the most important. We had a great element, that moment a few minutes ago with Newman. This may take the cake. So it's gone from 16 to 9 with no bid. Now let me ask you a question. I know you don't know this property exactly, but sort of, if you went, so where would it have been, say, I don't know, 6 months ago, 12 months ago, 2 years ago, pre-pandemic? Is 9 still a high price, or is that kind of, have we got back to use a stock chart? Are we back to like the 200-day moving average? I'm trying to get a sense if that's still a high price.
I would say it would have gone for maybe not 15, but 13, 14. It would, yeah, because we're talking about like super prime top end. It would be like a Manhattan penthouse. What's the price of a Manhattan penthouse,
Yeah,
right?
no, okay,
Same
okay.
thing.
So you're saying pre-war it would have gone for that amount, and now it's gone down to 9, and there's no.
And
Is that what you're saying?
yes, and the reason is if you look at the south of France real estate, and also in a lot of European centers, there's a lot of Russians that own a lot of real estate there. So if I'm a buyer, why would I jump on the first opportunity that's there, right? You kind of see that there's another 20 next to him, so you might as well just wait.
Whoa.
And if you want to link it, let's link it 1 second to the whole market. So we have the high end getting hit. On the low end, we're getting the energy costs, and I gave you the examples from on the ground. People are getting hit. 20% of their disposable income is getting eaten up by energy costs and everything else right now. So you have the low end getting hit, the high end getting hit, and the ECB has minus 50 bips, has negative 50 bips rate, and does QE at the same time. So you tell me why on earth would I own the euro? Which is quite important to the discussion that David was saying about the dollar breaking out, because the other side of the dollar is the euro. So,
wow.
Yeah, and that's why I say, everyone's focusing on the US dollar index. It's compared to the worst places in the world.
exactly.
I mean, go pull up the US dollar versus the South African rand. The rand has been strengthening the whole time. The Chinese yuan is stronger than the dollar over the last 2 years. Stop paying attention to the US dollar index. We should be looking at the trade weighted dollar index. And that's still intact, but it's getting close to breaking a trend line, which would suggest that we're just ignoring everything and focusing too much on, the survivorship bias of an index created 50 years ago.
Yes. So Shrub, let me ask a follow-up question. So that's a great anecdote, but then going into Spirit of Weimar, not just one thing. Okay, so this flat, which should have been 15 million, 13 million pre-war, is now 9 with no bid. Okay, fine. So to me, that's kind of like, when you have a hot IPO, Shrub, and
I know exactly what you mean.
Yeah, people put up, and when the last buyer is filled, the last order is filled, there's nothing behind it. And so it's like the first guy wants to sell. So he's like, wait a second, what do you mean I can't sell it at 15? It just sold at 15. Well, how about 13? No. It's sort of like the bid is way, way down. Does that make sense to you, Shrub?
Oh, absolutely. And it reminds me of the case where, they tell you, oh, you got to put for 100 because, you're going to get 10%, and you put for 100 and you get a full allocation.
Now, Shrub, let me ask you something differently. So when you look at other high-end aspects of daily life there, and you're in Monaco, if I recall.
Yeah.
Like when you look at like super high-end restaurants or car sales or other flats, are you starting to see this type of behavior elsewhere, or is this just the very beginning?
So one private bank, it's again a bit of a microcosm here, but one private bank had 5 salespeople. 2 of them were dealing only with Russian clients, and they froze 25% of their accounts, total accounts. So Monaco is kind of quiet, although it still has a lot of wealthy people from all over the world. But the Russians have kind of disappeared, and what I'm hearing anecdotally is that they've all shifted to Dubai. So Dubai right now is booming. So you had shifts out of Paris, Monaco, and other places into Dubai and maybe towards Asia. So I think Singapore took some money as well. So you're seeing a reshuffling of wealth in reality.
Wow. All right, so let's shift gears. So Dave, if you're still there, Shrub follows very carefully the funds flows data, and he's always really good. Every Friday, he puts out the funds flows, whether guys are buying EM or the US or the selling tech or whatever. And Shrub, maybe you could just talk about what's top of mind for you in terms of fund flows. I know you and I we comment frequently on Twitter. You made the point, if I recall correctly, that it was kind of interesting. Money was going to emerging markets for the first time, but could you just talk whatever's top of mind? I mean, to me, it's been mind-boggling that we've seen no selling to speak of in U.S. equity, plain vanilla mutual funds. And so, whether it's that or it's the money into EM, like how when you look at the flows data this week, the last couple of weeks, what is top of mind for you, Shrub?
So the first thing I notice is that the US stocks are still getting inflows. So we've been waiting for serious outflows, and everyone is saying, George, I always highlight this with you. People say sentiment is bearish. It's like, who gives a shit about sentiment? If positioning is bullish, I don't really care about the sentiment. So the inflows into US stocks has been consistent. Even this week with the market down, you had 4.6 billion of inflows in the US large caps. So that's the total. On the total market, you're still seeing inflows. You didn't really have any big outflow weeks the whole year. Um, the interesting thing for me is that there's money going into the large caps all the time as safety, but coming out of credit all the time. So it's been a consistent theme: money out of credit as a risky area, but money into U.S. large caps as a safe haven. And the other interesting part, which is relevant to our positioning, because I've been long energy, short tech, very vocally for the last 6 months. The positioning around energy versus tech is actually still quite benign. So even this week, there was no inflow into energy, zero. Yet on the U.S. large caps and the U.S. Large caps, you had 4.6 billion. Then on the U.S. growth versus value, you had no inflow on the U.S. growth as a sector, but you had 2.5 billion outflow in value. So, when people talk about energy is
Hey,
overbought or value is overbought, yeah,
Shrub,
sure, but there's
Shrub,
not that much
Shrub,
money coming in.
Shrub. Do you know how excited Marcellus is getting? He's right next to you. Marcellus,
I know,
do
I
you, do
know.
you want to comment on this, Marcellus? Marcellus, do you want to comment on this?
All I can say is this entire space has been music to the entire comms ear. it so many people are saying, "Oh, you're middle of the game. You're in this like sixth or seventh inning," and I just keep telling people we're very, very early still. Whenever I hear Shrub give out this data, it's just like the angels are singing from the heavens above.
And you know what's so amazing about this? Because I don't consider you two guys in the same echo chamber. I mean, listen, it was just you and Sohaib with the Mutual Affirmation Society, I'd say, all right, forget it. These guys just believe their own bullshit. Here's Shrub, sharp guy from Monaco, the other side of the world, and he's like, he couldn't make you happier if he tried. And he's just speaking truth.
I'm a very, very avid follower of Shrub and Trader Pamplona and that whole crew. They're excellent guys.
And by the way,
Thanks, dude.
Shrub for all you guys is a must follow. And Shrub, you and I were back channel talking before. We're gonna have you as a featured speaker sometime next couple weeks. I'm gonna interview you because I love
Great, fantastic.
love listening to you talk. It's just awesome.
Looking forward to it,
Good.
George. Looking forward to it.
Shrub, anything else top of mind you want to share with the room?
Now, look, I think to the topic of this oil versus tech, and it's great listening to David. And I'm just going to remind to the most excellent spaces you did with Stan Weinstein, where he said something really, really simple. He said, as long as it keeps working and the trend is there, just stick to the trend, right? Don't make it too difficult.
100%, 100%. All right, so listen, we're kind of we're going on 2 hours and 20 minutes. Dave's been really generous with this time. We have a couple more speakers to ask questions. If anybody else wants to ask a question, please raise your hand. I see we've got Alan Levins who's hiding down there and he won't come up. Come on, Andrew, get your ass up here. I do want to remind everyone, this is all going for a good cause. Central World Kitchen. Go on my Twitter feed or the YouTube page or Carol Strone's Twitter feed. There's a link there. Central World Kitchens is doing God's work. We make this room free. But we're doing our part. I want you guys to do your part, and please give generously to Central World Kitchen. The other thing apropos of that, we've now are in the process of we've created our own YouTube channel where we've uploaded I think a half a dozen or so of the past episodes. We're in the process of uploading all the other ones. The YouTube channel, which will I think eventually morph into a web page, will be sort of a central repository where all these great talks will be housed. Things like Shrub, you just mentioned Stan Weinstein. That's one for the ages. It's as relevant today as it was a week ago. It'll still be relevant 10 years from now. And so it's going to be a lot easier to access all this stuff. It's all going to be in one place. Now it's on a YouTube page. It'll be on a web page. And with that, there's also the link for the charity. And we also hope to set up a resource page so that when someone comes in, someone like Michael Howell, Jim Walker, whatever, they want to share a piece of research or whatever, they'll be able to drop it there. But again, I think we have the best content of anybody in FinTwit or in the internet. And, I want to keep it free, but I also want to channel the energy of this room for the good. And I think everyone give to the level of their means. If you're a student, you have a negative net worth, $10 rings does it for me. If you're worth 10 million bucks and figuring out what to do with your life savings, I mean, you do what you want to do, but if you don't cut a check for $1,000, like, you're nuts. I mean, just think of the value of the research you're getting in this room. Again, no personal benefit to me or Carol or anybody else here. Last thing I would say apropos of that, please, please, please go to the YouTube page and follow the channel. That'll help us a lot with the YouTube people. We need more followers. I think we need to get to 1,000 followers and, I don't know, 4,000 views or whatever it is before we can monetize. So we started today at 150. I think we're up to 330, so we're making good progress. But please, please, please follow the channel and tell everyone else to please follow our channel. All right, so Marcellus, I think you had a follow up. Did you not? Or otherwise, I'll go to somebody else. Marcellus, did you have a follow up?
I just wanted to let you know that I did put Carol's tweets up in the nest too. If people need to, get those
awesome.
links.
That's awesome. That's awesome. Okay, we're gonna go to Jeffrey. If you have a question for Dave Nikoski, I do want to stay away from macro spitballing. We've done enough of that here. So Jeffrey, welcome to the room. Do you have a question for Dave?
Not much, not exactly a question, just kind of an idea, and I love. I believe O'Hare is right on, and we've discussed this before. So, is the smart money going to start to invest in the commodities, and they could, because they're so under owned by institutional investors, wouldn't they start to crowd the space, and that's when we can get out? I've always loved the idea of selling to smart money. Just a thought. Thanks.
Yeah. Most of them adopted ESG policies. They're prohibited. They can't do it. So I think that's a big problem for them. It's kind of like starting a fund that's oriented towards growth or value. They're going to have 7 to 8 years of sunshine and 7 to 8 years of living it with just the moon in the sky. And I think that's just one of the aspects of market cycles. So I think it's going to be really tough for them to back up the truck, or until it gets to 5% of the market or 7%. There are some neutral energy companies out there that claim that they utilize drilling rigs with batteries on them. I mean, honestly, there are. So we've highlighted a few of them in the past. I think they're out on our Twitter page that you'd be able to see. One is CIVI and one is CVR, that represent themselves as ESG type companies. So I think in going back to that aspect of when are they going to come into it? I mean, you look at a chart, something like CLF or Cliffs. It broke through the support at 20, melted down to 16. Now it's at 33. I mean, within less than a month. People are starting to recognize that there's a problem in the materials sector. And I think that we see that same type of action in energy at some point. And, pinpointing the day is extremely difficult to, say it's next week or a month from now. If things go to hell in a handbasket in the market and we have a major sell-off, I think it's going to take down everything.
David, can I just add on to that? Because I'm seeing that here in California. In fact, we just read a piece just last week about some of the smaller foundations, endowments here in the state of California who've moved out of energy investments, mining investments, commodity related investments over the last decade, and into more ESG driven type policies. And We were just reading something that a buddy of mine had put together, and they kind of pulled some of these smaller institutions, and you're starting to see a little bit of percolation in the movement away from all ESG at any price into more into more of a open-mindedness about energy again. And that's just starting. It's not going to be to your point, it's not going to be an event. It's going to be a process. It's going to happen over time. And I think what you're going to see is as energy outperforms, as commodities outperform. If you're a CIO at CalPERS or CalSTRS and you're sitting there, meeting with your investment committee, and you're missing the boat quarter after quarter after quarter after quarter, and on the other side, your private equity investments that you put 10% of your fund in are now being marked down, and your tech investments are being marked down, your all this other stuff that they've been in is being marked down. You got to ask yourself a question: at what point do you start to pull the trigger and start to swing that pendulum the other way? And I think that's starting to slowly kind of happen. And and one other thing too, a lot of people don't realize that the three largest energy companies in the world, right? Chevron, Exxon, Shell, and many others, but the three largest, they spend billions of dollars on ESG type research every single year. So the most money that's spent in this space is actually by the hydrocarbon monsters like the three largest companies. I mean, Chevron here in the Bay Area, they have a whole lab set up to do all this R&D in clean energy. So I mean, to me, I think once that tide starts to shift, it's going to go pretty quickly, and it's just going to ramp. But I just want to touch on one other thing. Somebody was mentioning earlier about these spreads in real estate as anecdotal evidence of things kind of happening. That's absolutely right, but that's just one thing. I mean, I've talked about on these spaces for the last few months about spreads widening all over the place. I mean, if you look at mezzanine loans, CMBS, or MBS, or even high yield, those spreads have started to blow out. I mean, when you have bid and ask spreads starting to blow out, that is literally the indication that things are not good, right? When spreads are really tight, things are great. When spreads start to widen out, and they continue to widen out over weeks and months, that's an indication that there's a lot of consternation under the surface. So I would just say people need to keep an eye on that.
Thanks for that, O'Hare. All right, ladies and gentlemen. With that, I think we're going to draw this from a close. We're going on 2.5 hours. It's been a great space. Dave Nikoski, I thank you profusely for doing this. I hope you've enjoyed it and you've learned from a lot of the folks in the room. And I consider you a friend, a sharp cookie. I hope you'll consider coming back again. For those of you that are interested, David can be reached at dave@vermilioncap.com. And I'm sure, mention you heard him in this room. He'll give you a special George deal, discount code George. So at any rate, with that, I'd like to draw the room to a close. We'll be sure to we're going to have, we've got a lot of exciting things planned, and the hits keep on coming. I can't tell you the momentum we're building, the number of speakers I have lined up. It's just going to blow you away. So I think we've really created something very special here, and I'd like to continue this. But again, there's an ask here. I'd like you to give to charity, not to me, but to charity. I'd also like you to follow our YouTube channel. It's No Bull Market Talk with George Noble. You can find it. It's in my Twitter feed. It's in Carol's as well. So with that, everyone, enjoy the rest of your weekend. Thank you again, David Nikoski. Really appreciate it. And look forward to having you back again. Thank you, everyone. Take care.
Thank you, George. Bye-bye.
Thank you, Dave. Thank you. Bye-bye. Just a few comments, and I want to get to Dave as quickly as possible. This past week, I can't say it's really any great surprise. We've spoken before in this room about how in bear markets, and I believe we're in a bear market, you typically see counter trend rallies. We've had John Roque, who's a friend of this room. He's been in the room, and we've cited his study many a time, going back